I always say what we see today. This large new office is years of sacrifice and hard work. Relax. I know it's a tough job, son. Clients can be tough. Times can be tough. Situations can be tough. Half a day. Half a day is all I give you to feel sorry for yourself. Then it's on to the next. You need to have a tough skin.
A tough skin. The stories I could tell you. You see, people tend to see the big picture, the rosy picture. But let me tell you one thing. Being an entrepreneur is, tough.
Son, a business has a life of its own. One bad day at the office doesn't mean the end of the world.
Winners are not people who never fail, but people who never quit.
The sweet smell of success. Half a day. I give you half a day to enjoy it. And then it's on to the next. There's only one
right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term. PPFAS Mutual Fund. There is only one right way.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
पापा गोवा चले?
हाँ चलेंगे ना अगले महीने।
पापा गोवा?
हाँ अरे गोवा का मजा तो ठंड में आता है।
पापा गोवा?
अरे ठंड में गोवा कौन जाता है?
पापा कब जाएंगे गोवा?
अगले साल पक्का।
एसआईपी लिया होता तो ये नहीं होता।
मम्मा
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
टिकट बुक कर रहा हूँ माँ कसम।
Investor Education and Awareness Initiative by PPFAS Mutual Fund. Investor Education and Awareness Initiative by PPFAS Mutual Fund.
Good afternoon, everyone. Thank you all for being here and spending time with us. It really means a lot to us that so many of you all have come, given up your Saturday afternoon and to spend some time with us. From heartfelt, we are very thankful. Thank you. I'll need to read this disclaimer, else I'll be in trouble with my compliance on Monday. So, viewers should note that the objective of this meeting is to communicate with our unit holders and share our thought process with them. The views expressed here are based on information available in the public domain. Views expressed here can change depending on changes in circumstances. Nothing discussed here constitutes a buy, sell, hold recommendation. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully. So before I start, let me just introduce who all we have today. First, we have Mr. Rajeev Thakkar, CIO, PPFAS Mutual Fund. Then we have Fund Manager Raj Mehta, Fund Manager Ron Akonkar. We got Mansi, sorry. And sorry, I missed Rukun. Rukun is also here, Rukun Fund Manager. And Mansi is again Fund Manager. She is the newest Fund Manager in PPFAS. And I'm Neil. And thank you again for being here. So the flow of today's meeting would be that I would give you some boring facts about our mutual fund, because that's exactly what my presentation is, a tale of a boring fund house. So I'll be talking about that. After that, I will ask Rajeev to say a few words, and then we'll do the Q&A. And I have forgotten one very important person, Mr. Neil Borate, who will be taking care of the whole event. And I thank Neil for taking time out and being here again with us, and means a lot to us. Thank you. So let me start with something which is, I think, very apt today, because people somehow have forgotten that investing is supposed to be boring. The day it turns exciting, you are not investing but gambling. So let me just put that out there for everyone to just keep that in mind when we go. And investing is like the law of the farm, A seed has to go through various seasons, various time periods, years, decades, for it to become a fully blown tree, and then to bear fruits. And that whole process is very boring. It's not an exciting process. It takes years, decades for the seed to become a full-grown tree. So investing is just like that. You need to give it time. It's supposed to be boring. It's not supposed to be something very exciting. And continue, and holding your investments for a long time, for a long term, is the key to gain financial freedom. So on that note, people keep asking me, again, my colleagues, it's very boring, you guys are very boring, kuch kar nahi rahe ho, you are not doing anything, same old things you all are telling us, same old things you all are doing, you are not launching any scheme or anything. And thinking about it, we are very boring. We don't launch NFOs for asset gathering and to take advantage of what's hot in the market. That's not the way we like to do things. What we like doing is running a diversified strategy in equities. Now, how does this help us? So again, if we like a particular sector or a particular market cap or whatever it is, we can take advantage in the Flexi cap. The name is Flexi cap, means flexible investing. So we can go wherever there is opportunity. And as such, we don't feel the need to slice it and dice it into various schemes and funds, So we would prefer it this way. This has been successful for us, and that's kind of the strategy we will keep running. So surprise, surprise, no new schemes launches planned also from our side as of right now. So a lot of questions were asked about, will you start this fund, that fund? Again, the excitement part of it, we're not going to be launching any new funds in the near future. We don't chase fads and fancies, So if there are things that we don't understand, it's better not to invest in it. And we keep that on the side. We don't invest in high-priced or very risky IPOs or things that are just a new age or something like that, So again, if the trends are risky and if the valuations don't make sense, we will stay away from it. We prefer clarity in offering in terms of how can we simplify things for our end investors, in terms of communication, in terms of providing solutions. So today, world over, for the last few years, world over, the finance industry is based on complexity and confusion, I mean, that's what it is. I mean, the more complex and more confused the investor is, the more the industry makes money. So it's not in anyone's, it's not worth anyone's time to give simple solution which is actually in the best interest of investors, And if I tell you, and let me put my neck out and say that I think for most people, 2 good diversified mutual funds and 1 large cap index fund should be more than enough for their equity investment, and that does fantastically well. Not many people will give such simple solution because sometimes it's not in their favor, or you know, things are not gelling with you in the sense that there's a mutual interest, you know, mutual interest of you doing well. And the big issue today because of that is over diversification. You know, people are way over diversified. They're getting into all kinds of schemes and things like that, where you probably don't need so many schemes. I think the more schemes you have, the more suboptimal your returns can be, you know. So be careful about that. Align yourself with people, with asset managers, wealth managers, distributors who actually care about you and actually have your best interest in mind. So again, our offering bucket is very simple. We have two funds for cash management needs, which is the liquid fund, and one is the arbitrage fund. We have two hybrid funds, which are debt-focused, Parag Parikh Conservative Hybrid Fund and the Dynamic Asset Allocation Fund. So again, people who are looking for debt allocation, I think the Dynamic Asset Allocation is something you should probably look at, you know, for your debt allocations. And then we have our core equity allocation, the Flexi Cap and the Tax Saver Fund, you know. So it's a very simple offering bucket, cash management for something you have less than 1 year need, equities for more than 5 year need, and for your debt allocation, you have our hybrid fund. So I think this more or less takes care of most people's allocation needs. So no excitement also in terms of in bull markets for us. We are very boring. We've got a long history, and we've kept cash, and cash has been a feature of our fund house and not a bug, as they call it, you know. We've had cash from periodically when valuations are expensive and we are not finding valuation comfort. And the reason sometimes is that, you know, what you pay today for a asset will determine its future return. So if you pay a high price today, your future returns will be not that great. But and our job is to find those values, those undervalued, when stocks are undervalued, that's the time we need to buy it. We need to buy low, sell high. And for that, sometimes, yeah, we do need to take short-term pain for long-term gain, you know. So sometimes we do feel that, and the fund will periodically probably test a bit of your short-term patience. So that is kind of the strategy we've used, and it's been pretty successful for us over all these years. Very boring marketing campaign. I think we don't really have even a marketing campaign as such, you know. So today when I open my email box, there are half my email boxes filled with hurry up, last day to invest, don't miss the biggest opportunity, have you invested in this scheme, hurry up, once in a lifetime opportunity, and all those things, you know. And the spam mails are quite a lot these days, and we don't believe in any of that. We will not spam you, we will not spam email you or push for sale just for the heck of it. But yeah, there will be one or two opportunities. If we think it's in your best interest, we will come knocking at your door and tell you that, okay, increase allocation. That will probably be once or twice in a decade. Okay, so that's something we there. But what we do want to do, and the marketing approach, if you can call it that, is what we do today. This 4-hour meeting with you guys. We prefer honest, direct conversations with you all. We want to answer your questions, whatever questions you all have from us, and we want to be very transparent in our approach in terms of answering that, and even telling you all about what we actually stand for, what the mutual fund stands for, and where your expectations should be, you know. So this is our very boring marketing approach. No excitement for our distributor partners. Also, we have one commission for all. We don't distinguish between people, the biggest or the smallest distributor partner, mutual fund distributor will have the same commission from us. So there's no difference in that. There's no fancy structures. And the reason for that is that then our relationship managers can have meaningful conversation. Instead of just talking about commission where 90% of the time goes, we can have real meaningful conversation about the mutual fund or about various things in the market, you know. So that has really helped us build that one-on-one trust with our partners. And we're very thankful for some of those partners who've who've partnered with us, because we do realize that this model, it does not work with everyone. In fact, me and Rajeev have been unceremoniously kicked out of distributor offices last 7-8 years. Today, they are still a little kinder to us, but 7-8 years back, we were in no uncertain terms kicked out of their offices. So we are really thankful for those distributors who've really connected with us, who've understood our thought process and are working with us, So in the end, our goal is to just attract investors, partners, in a community, just make a community of like-minded investors and partners. So that's them. So we are boring, but I think we're a very responsible fund house. And our vision is to be India's most responsible and trusted fund house. That's our vision. Our mission is to help clients achieve their long-term financial goals through prudent fund management. We want our actions to talk louder than our words, When we have our vision, which is about being responsible, and our mission is to help clients achieve their financial goals through prudent fund management, then we have something called a big fiduciary responsibility towards our unit holders. And we are responsible for doing what's in your best interest if we want to be the most responsible fund house. So one is, we look at this as a profession and not as a business, and the difference is a professional like a lawyer or a doctor will give you advice on what's good for you. A business person will think about all the metrics, revenue, AUM, profitability, all that stuff, and they will try to generate the maximum out of that without not really caring about the end investor and what's good for them. So one thing we've done for a fiduciary responsibility, like I said, actions speak louder than words, is that we don't have targets for anyone in our office, in our organization. Nobody has targets. And that could surprise people that how you don't have targets. But think about it, like if I'm telling you that we want it to be like we want to be professional like a doctor or a lawyer, you tell a heart surgeon that, boss, every month you do 30 heart surgeries, that's your target. On the 29th day, if you go with a gas problem, that guy will cut open your heart, even if you don't have that problem, right? And that's what kind of happens. If you have targets, then people will sell you things you don't need. So we don't have any targets. We want people to communicate the prospect, what our fund stands for, our philosophy, our values. And if that gels with you all or with anyone, then we welcome them to invest with us. Like I said, we don't have any flavor of the month schemes. If we were business people, then we'll just be having NFOs after NFOs for garnering AUM. We don't have that. And that leads us to no clutter in offering, but we don't even have survivorship bias. So the advantage, and so I'll come to survivorship bias, the advantage of having a lot of schemes, 20, 30 schemes or what have you, is that at any given time, 2 or 3 schemes are always doing well, right? I mean, so you can hide your non-performing schemes and market the ones that are doing well. For us, for all purpose, there's pretty much one scheme, right? The Flexi Cap in the equity space, the Flexi Cap and the tax saver. So we have nowhere to hide in terms of if the performance is poor or any of that, we can't market some other fund, and which is perfectly fine for us. We don't want to even hide behind anything. So for that, we don't have any survivorship bias. Whatever you see is whatever you get. And one thing is that we're not here to make a quick buck out of anyone. We are here to make generational relationships. If you have invested, we hope that your kids will also invest. And if we act responsibly, and if we can get enough trust from you all, then I don't think that should happen. I mean, that should not happen. I mean, your families and everyone should probably, we want to make those generational relationships. So again, one thing again, a bit about responsible investing versus forceful investing, right? I mean, when investors have given their hard-earned money to us, our job is to do common sense investing. We don't have to force ourselves to invest when things are a little expensive. We don't feel like putting our own money right now in certain stock. Why should we put any of our investors' money in that, So again, being trustees of your money, a commitment to act in your best interest, And in bull markets, people forget that, yes, returns is one thing, but the big thing, which is more important, is risk management, Because if you manage risk well, returns will follow. So we don't, again, like I said, again, we don't force ourselves to invest when things are, if we are not finding enough opportunities, and there we will see some cash position build up sometimes. And that, for that, we don't mind investing in such times. So this is by design, is that sometimes underperformance is not that bad in times like these, you know. So, and I will show you with data also that what I'm saying is how have we done that. And in the end, what do we want to earn from what we are doing, you know? I think what we want to earn from you all is goodwill. What we want to earn for ourselves is a good night's sleep, you know? I think if we can just continue doing that, then whatever the world judges us by, AUM, rating, ranking, revenue, what have you, that will come. It'll come at a slower pace, but it will come, which not, I mean, it's a fiduciary responsibility, and if we are doing our fiduciary responsibility, all those will also come, but that is not the focus for us. Our focus is to build goodwill and trust, and if we can do that, we earn ourselves a good night's sleep, and that's exactly what we want. So I was telling you how we done. This is our 10-year performance for Flexi Cap Fund. Now, on my right, so your left, the risk versus the category. Our category is the Flexi Cap category. Our risk is low over a 10-year period, and the return versus the category is high. That's what people want from investments, low risk, high return. And obviously that will happen over time. I mean, obviously we slice and dice it over 6 months and 1 year. That could obviously be all over the place, you know. So that's why we said that this is a boring process. Investing is supposed to be boring. And over a 5-10 year period, you can get such wealth creation. So let me go also to on my left side, which is a very interesting chart, which is the upside downside ratio capture. What does upside ratio say? If the index, which is the Nifty 500 goes, that's our benchmark, right? So that's the benchmark we're using. If the index goes up by 100, the category, Flexi Cap category will go up by 95. And we will go up by only 84. What I said that sometimes it's okay, sometimes to underperform, and that's what the data says, that PPFAS mutual funds will not capture all the upsides in a go-go bull market. But the interesting is the downside protection. If the market if the index goes down by 100, the category Flexi Cap goes down by 90. We only go down by 45. Now, if you can do this consistently, then you get low risk, high return kind of a portfolio, you know. And that's what we are trying to do, and that's what we've been doing over all these years. And the data also proves that what we are doing, what we are saying, we are walking the talk. Again, AMC can mean two things: asset management company or asset marketing company. We have to choose what we want to be. We want to focus on managing our assets responsibly, not on flashy marketing. The biggest reason is because we've got our own skin in the game. And we've got our skin in the game way before the skin in the game circular had come. So, in fact, we are the first people we are the only people, I think, to even today to voluntarily put how much each of us have put in the mutual fund in our personal capacity. And that keeps changing on a month to month. So for us, most of our personal wealth depends on the NAV growth of the mutual fund, not on the AUM growth as such. So when we are also aligned with you all, then I think what we want to do is just manage the portfolio in a responsible way. We don't want to do anything else. So that's why our skin in the game is very important, and majority of all our wealth is in PPFAS mutual funds. So when will we launch a new scheme? So people ask that, okay, you're not launching anything. When do you all launch a scheme, you know? So we'll launch a scheme when 3 conditions are there, you know. One is if there's an actual value proposition for you, or if we can find some differentiation in the category that we are going to be launching in. And third and most important is if we are excited to put our own money in such a scheme. So for example, the dynamic asset allocation fund, when we launched it, I think one of the big things that we had discussed is that it would be very helpful for older people in our own families to invest in such a scheme, you know. And we're like, and that's how the whole creation of DAAF started. That look, there's so much of, there'll be so much, it'll be so great for people in our family to invest in this kind of a product. We're like, yeah, and if we are thinking that there will be people in our families who will be excited to invest in this, I'm sure there'll be other people who will be invested, who will be willing to invest in this. And That's how we launch a scheme, when we actually see a value proposition and if we are excited to put our own money in such a scheme. So today also, last I guess 20 minutes I've been talking. A lot of people, some people are always fidgeting on their phones or looking at something or the other, you know, and that's what our behavior is tuned to now, right? Keep on doing action, action, action. And that also gets translated in the capital markets in the sense that everyone wants to do action. Yeah, I want to buy something, I want to sell something, I want to get something, I want to get something new, kya naya hai, what it is, I want something exciting, you know. That is, I feel, sometimes where inaction actually helps. And inaction or being lazy, having patience is what it is all about, than greedy. So we rather be lazy than greedy, because greedy is always about chasing return. Lazy is sometimes, listen, you just need to chill, you don't need to do anything, let your investments do their thing, you know. So again, we have a blinkers down, and blinkers down is if you've seen any horse racing, the horses have their blinkers, so they can't look left or right, and they just run their race. Similarly, that's what we want to do. We just want to run our race with, which is on our terms, with the conviction we've got on what we want to do. We are not going to be looking left or right and seeing what other people are doing. Oh, others are doing this, so we should also do that. That's not what we are here about. We want to run our own race. We want to sometimes be lazy about it in the sense that have good amount of patience instead of just having mindless actions, doing mindless action, which actually affects the overall portfolio, affect the overall return and risk of the portfolio. So in the end, it's the tortoise way. If you are seeking a lazy, boring, responsible fund house, then you are in the right place. If you're looking for excitement, then I guess we're not here for you. So with that, I will end my presentation, and I will hand it over to Rajeev for his opening thoughts. Thank you.
Good evening, welcome. Thank you for spending your time with us. Let me welcome Mansi on the dais. She joins our investment team, and hopefully it dispels the rumor that to be part of the investment team, your name should be starting with R. People thought we believe too much in numerology, and the alphabet matters a lot. Next to Neil Borate, there's Rohil. So I guess he missed out. So he's also our colleague at PPFAS. I'll probably try and spend some more time on the opening remarks so that we can address a lot of questions which are there in some clusters. The entire raw data has been shared with Neil Borate, and he has the, just one second. He has all the questions, but while looking at the list, I saw that people have concerns around 2 or 3 larger clusters, so I'll try and address those in the opening remarks so that probably the Q&A later on can move a bit faster and most of the common concerns get addressed right up front. Let me start with an analogy. Investment journey, investment vehicle, instead of talking about it, let me talk about a road trip and a vehicle for that road trip and the driver that you have for the road trip. Let us say you are going from Mumbai to Pune. Works for any road trip. It could be Delhi to Shimla, it could be Bangalore to Medikeri, it could be Kolkata to Darjeeling. Any road trip, just think about it. What do you want from the vehicle that you hire? What kind of a driver would you want? How will you evaluate the performance of the vehicle and the driver while the road trip is happening and at the end of the road trip? Obviously, you don't want to go in a bullock cart, right? So speed, of course, matters, but is speed the only thing that you will evaluate the vehicle and the driver on? You want to see whether the vehicle has a good NCAP rating, whether it has adequate seat belts, airbags, proper suspension. You want to ensure that the driver is not under the influence of alcohol. You want to ensure that the driver has had sufficient experience of driving a vehicle. While driving, you would expect the driver to stop at red signals. You don't want the driver to run over school children crossing the road. If there's a speed breaker or a pothole, you expect the driver to pull back on the accelerator and maybe even apply the brake lightly. You don't expect the driver to drive at 150 kmph all the time. If the passengers are in a need of a coffee break, a tea break or a bio break, you expect the driver to halt for a while. It's not about how fast your vehicle went over the last 10 kilometers. And if your vehicle was slow for the last 10 kilometers, then you get jittery and try to switch vehicles midway. If you are going on the hilly terrain, if you are passing Khandala and Lonavala Ghats, you would expect the vehicle to go slowly. You don't expect the driver to drive at 150 kmph on turning roads, narrow single two-lane roads, or on potholed roads. But then why is it that when it comes to our investment journeys and when it comes to our investment vehicles and our investment managers, the last 6 months and the last 12 months matter so much? Entire chatter is around how have you been doing over last 6 months, how have you been doing about last 12 months, why is cash there, why are you not deploying, why is this much allocation to small cap, mid cap, and all sorts of things. Just like you would expect the vehicle to slow down on hilly terrain in investments, if valuations are stretched, if opportunities are hard to come by, you would expect people to, investment managers to slow down, to be a bit defensive on their investment style, to have a certain amount of cash build up in the portfolios. So I would urge people to look at the investment journey over the longer term and not to have this single point agenda of beating the entire peer group or even beating the indices. Let me admit one thing today. I have this huge envy of the life insurance industry. Right here, we worry about alpha, beta, theta, portfolio cholesterol level and blood pressure. LIC and HDFC Life get away with zindagi ke saath bhi, zindagi ke baad bhi, ya sar utha ke jiyo. That's all that they communicate to you. And which is actually right. What matters is, are you meeting your life goals or are you meeting your financial goals? That's what matters. Rather than worrying every day about 0.5%, 1%, underperformance, outperformance, and all sorts of things. So, chill, don't have too much expectation that 1,000 rupees SIP is not going to make you richer than Elon Musk, either which ways. And whether you choose a slightly underperforming fund or outperforming fund, ultimately, over the long run, your investments will be driven by your asset allocation and time that you give to the market rather than individual scheme selection or individual stock selection. I think people who have come into the market over last 3-4 years, it will be great if you can read a little bit of financial history and learn. Otherwise, market in any way will be there to teach you. And that is an expensive lesson to learn if the market teaches you. If you look at financial history, you look at the lived experience of other investors, I think that's a better way of understanding how investing works. A lot of chatter has been there around the size of the portfolio. Don't call out the answer loud, but think about it. A stock with a market cap of 80,000 crores, where would that stock fall? would it be a small cap, mid cap, or a large cap? Answer is 80,000 crores. Small companies are now mid caps. A company valued at 25,000 crores is a small cap today. So while our size has grown, the market itself has grown very, very significantly. We have mentioned this in the past. The reason why Flexi Cap Fund looks large is because we run a single strategy. People who slice it and dice it will have lot of schemes with lower individual AUM. But at the asset management company level, the AUM will still be very, very high. And what matters in terms of liquidity, in terms of flexibility while buying and selling, is the size of equity assets at the AMC level rather than at the scheme level. So we have not been chasing market share. Neil spoke about the limited number of schemes. If you look at the entire past 12 to 24 months, the whole action has been around thematic funds. So last, I think, thematic funds and sectoral funds had AUM exceeding 4.5 lakh crores. We have not launched anything over there. It seems that we are a large fund house, but again, it's because of a single equity strategy scheme. People worry about, will we be able to deploy money in small caps, mid caps? We've been selling the small and mid caps that we own. Leave aside buying more of it. And why is that? It's nothing to do with liquidity or our size of AUM. It's just that the opportunities today are better in the larger companies on account of valuations and the kind of outlook that we have. There have been questions around overseas limits. So no update over there. Our friend Neil Borate had asked the outgoing governor on when are the limits going to be increased, and he said in due course, in summary, or we'll decide at the right time. Now we have probably a new governor, maybe its time is ripe to ask the question again, but no update so far. People have read reports in the media around PPFAS setting up a gift city operation. So, and there have been a lot of questions around that. As far as overseas investments go, no impact on the mutual fund. So even if the gift city operation is up and running, the mutual fund is not allowed to invest in that fund and invest overseas because the limits remain where they are. What that enables is, for those individuals who are so inclined, people can remit money outside using LRS and invest in a gift city fund with a dollar NAV and which invests globally. So that is one outside investment kind of answer. That activity will have nothing to do with the asset management company or the mutual fund that we run over here. The other part is people living abroad, those people wanting to invest in India. So over there will be a linkage with the mutual fund. So the gift city structure will have a feeder fund which will invest in probably the Flexi Cap, and the overseas investors then don't have to bother about opening a account in India and having a custodian in India, getting PAN number, filing tax returns in India. They can invest in this gift city vehicle directly and avail of the benefit of investing in India. So that's as far as the gift city goes. I have a few things to talk about in terms of the valuations and in terms of the way things are and why I think certain things are not adding up and people are probably behaving very, very optimistically when it comes to investing. Everyone has this bull case on India, and I agree with that. I'm patriotic, I'm optimistic on India's prospects in the future, no dispute over there. But then people take it one step forward, saying as India's GDP grows, people will have a lot more discretionary income to spend. And because of that, certain companies, certain sectors in India deserve this outsized valuation premium. Okay, now let's examine this bull thesis with facts on the ground and with what is really happening. Because of this India consumption story, GDP growing, more discretionary income, in the first round, we bid up all the FMCG companies in India. Again, I'll be naming companies, but it's just to give an example. There's no buy, sell, hold recommendation on any of the companies that I'm talking about. So when we had this consumption growth story, we bid up everything in FMCG, HUL, Nestle, Dabur, Marico, everything got bid up to 50, 60, 70, 80, 90, 100 times earnings, right? People said, India growth story. After that, people said, oh, D2C brands will also do well. So leave aside the legacy brands, people creating new brands will also succeed. Now, if you step back and think about it, if D2C brands have to succeed, it will reduce the growth for the traditional FMCG companies. But even leaving that aside, people bid up the D2C brands and all the e-commerce brands that were there. Then people got very excited about big box retailers, the organized retailers, JioMart, Star Super Bazaar, D-Mart, More, and all the big, Vishal Mega Mart, all the big box retailers. People said, these people will gain because they have private labels. Private labels will enable them to get extra margin. Now, if private labels gain, then it's again negative for FMCG and D2C companies. Okay, we bid up all the retailing companies saying huge amount of growth story. Then came quick commerce, 10-minute grocery delivery. Now we said that is also very exciting. So we bid up Zomato, Swiggy, Unlisted, Zepto. Amazon is also entering that space. They've begun with Bangalore. Flipkart is coming in. Various other players are doing Big Basket. Various other players are coming into 10-minute grocery delivery. Now, okay, you can be bullish on Indian consumption, but will all these players together win? I have my doubts. All of these are great companies and the great founders, the companies that I've named, and I have nothing against them. But somewhere, something has got to give. That is my opinion. In the marketplace, people have a different opinion. Everything is bid up. Go sector by sector. Let's say paints. You have great legacy paint companies and you have well-funded newer players entering the market. Somewhere pricing power has got to get affected. Somewhere the volume growth has to be affected. That is my opinion. Other growth areas, discount stockbrokers, wealth management, asset management, investment banking, everywhere the story is the same. Volume growth is there, but the number of players entering that space is increasing. There is a huge war for talent, so a lot of poaching of employees is happening at higher and higher salaries, potentially reduction in pricing power, and somewhere down the road, reduction in margins. So when I am saying that we are cautious, it is not that I am bearish on India as a country. It is just that a few things have happened. Starting valuations have become very, very high and competitive intensity has increased a lot. Then people ask us, why don't you buy more of what you already own? Now let us say we like private sector banks. Can I have the entire portfolio consisting of private sector banks? Answer is no. You will have some consideration to the portfolio weightage you want to give to individual companies, and for various reasons you may decide on a particular weightage for a particular company. Just because you have cash, you will not keep buying more and more of what you already own. So that is another reason why many times cash builds up. As a thought experiment, Just think about it. Let us say PPFAS mutual fund existed in 1990, right? And instead of December 24, right now we are in December 1991. And we are having a meeting like this, and you are looking at the performance of the Flexi Cap fund. In December 1991, if we are not owning Mazda Industries, or if we are not owning ACC at 10,000 rupees, then we would be massively underperforming the market. Now, would you want your fund to underperform or outperform at that point in time? If we are in December 1999, if Flexi Cap fund was not owning K10 stocks as they were called, Ketan Parekh stocks, DSQ software and the likes, we would be underperforming the market. Would you want us to underperform at such times, or would you want us to outperform at such times? If we were in December of 2007, if we were not owning the infra companies, the real estate companies, and this happened in our PMS avatar, we were not a mutual fund then, but this has personally happened to me as a PMS manager. There was a huge amount of underperformance. Ultimately, when the terrain is hilly, when you are on ghats, when there are speed bumps on the road, when there are potholes on the road, you want to slow down. You don't want to step on the gas all the time. We will invest when we get the opportunities. Meantime, please have patience. Again, a lot of you probably already know this, but some people may have this impression that when we say we are 20% in cash or whatever, we don't have currency notes piled up in our office. That money is invested in money market securities. Those money market securities give us an annual interest rate of around 7.5% these days. Now, hypothetically, if equity gives us 12% return, then instead of 12, let us say we will get 7.5. We don't know what the equity return will be. I'm just throwing out a ballpark number. Let us say because of that, we do lower than equity by 4.5% on that 20% for 1 year. Now, in that 1 year, even if 1, 2, 3, 4, 5 stocks go up and down 5, 10%, 15%, that will give us an opportunity. It is not that we are committed to staying in cash for 1 year. Anytime there's an opportunity, we can sell those money market securities and deploy in equity. So that is something which provides us the opportunity. People ask, what is it that you know that we don't know? Why are you so bearish? We are 80% invested. You could say we are actually 80% bullish. It's not that I have any insight into some impending market crash or something that is going to happen. Whatever I know is already there in the public domain, and I keep talking about what our reading is in terms of valuations and things like that. It's just that it gives us this additional purchasing power whenever individual stocks or sectors sell off and we get the opportunity. Why is it not such a great time to be being fully invested? Every promoter, be it the government, be it the private family businesses, or be it MNC promoters, all of them are finding it attractive to sell down in India. Whirlpool sold down its stake. Hyundai did an offer for sale for their auto business in India. LG has filed a prospectus. Walmart, which fully owns Flipkart, they are thinking apparently based on media reports about converting the Flipkart's listing country to India and doing an IPO here. The number of QIPs that you keep seeing, private equity funds who are selling down. So while mutual fund investors are saying SIP sahi hai, at the other end, promoters are saying QIP sahi hai. They are coming out with offerings all the time. So it is not that if you don't invest today, you will never get an opportunity. Supply will be there, and could possibly accelerate. You will get opportunities to buy. It's important to be patient for deploying. Yeah, so again, just to probably belabor the point, sometimes it's better to look foolish rather than to act foolish. And internally, Neil, the entire investment team, all of our colleagues, we are clear. If there is a risk that we will lose half of our clients because of redemptions, that is okay with us. But we will not risk losing half of our clients' money by doing foolish things on the investment side. I guess that covers the bulk of the cluster of questions that were there. Hopefully it makes Neil's job a bit easier. So happy to dive into the Q&A. Thank you so much.
So, hi everyone, this is Neil Borate. I am Personal Finance Editor at Mint, and I'm also here in the capacity of being a unit holder of Parag Parikh Mutual Fund. I've been a unit holder for the past 5 years. I've been told that some people have come from as far as Mangalore and Delhi. So big shout out to you guys. You want to raise your, whoever is from outside Mumbai, you want to raise your hands? Fantastic, fantastic. I keep drawing parallels with Berkshire Hathaway, and clearly we are getting there with people flying all over the country to attend this. A lot of the times I meet young people and they are very enthusiastic about investing in stocks, especially in this bull market. Some people are also enthusiastic about F&O. And when they tell me that, which stock should I buy, or, I spend so much time trading, I ask them, what return have you got? And often I hear returns like 25 or 30%, which perplexes me because sitting in my living room doing nothing, I have got 30% in Parag Parikh Flexi Cap in the last year. Of course, let's not go by 1 year return. Last 5 years, it's around 26%, and the last 10 years is around 19%. So sitting at home doing nothing, I have got similar returns. I don't have to stress about company results. I don't have to keep checking my phone for stock prices. This strategy has served me rather well. So before we get to the questions, just one big round of applause for the fantastic team here. The way I see it is, why would you want to compete against the likes of Gukesh when you can just hire, the Gukesh is sitting here to manage your money. So with that, let's begin with the first question. So this is for Rajeev. What are your views on investing in growth-oriented themes such as artificial intelligence, electric vehicles, renewable energy, solar, etc.? Is it possible to have exposure to these themes in the portfolio?
Sure. I briefly spoke about, or on different platforms I have spoken about investing based on top-down approaches. So based on themes that look attractive, keeping that as a starting point and then investing. Let's hypothetically again go back to 90s and try and imagine ourselves as investors in that era. Two of the themes that would have appealed to investors at that time would be, one was the opening of the private airspace to airlines, for private airlines. So earlier you had Indian Airlines, which had a monopoly on domestic air travel, and private sector airlines were allowed to operate. Now this seems like a no-brainer. Private sector airlines will offer lower prices, better service, newer aircraft, younger in-flight crew, cheerful personalities, hospitality, all of that. Why would you not invest in those? Now, a lot of people may not even remember the airlines that were around at that time. East-West Travel Trade Links, Modi Luft, Damania Airways, NEPC Airlines, Kingfisher Airlines, which came in later on, Air Deccan, Air Sahara. None of those airlines are around. Indigo came in much later, and that's the one surviving airline. Similarly, another theme would have been telecom companies. So earlier, MTNL, BSNL had a monopoly, and you had private cellular companies. Bharti Airtel is the only surviving company of that era. Rest all companies have gone broke. So, being aware of a theme which is coming up is important and it's essential, but it's not sufficient. With a theme, with volume growth, you need good management quality, less competition, you need pricing power, you need decent balance sheet, some amount of luck. All of these things have to be coming together, and only then will an investment succeed. So we are participating in some of the themes that are mentioned directly or indirectly. AI, for example, we are invested in the companies like Alphabet, Google. We are invested in Meta. We are invested in Microsoft. And we are invested in Amazon. Amazon, of course, is not doing too much on primary models, but they are benefiting from cloud computing workloads. We have missed out on maybe something like NVIDIA. Solar, while we don't have module manufacturers or something like that, we are invested in transmission companies which possibly will benefit from the increased share of renewables and overall growth in power demand. So we meaning all our research colleagues, keep track of what is happening in various sectors, in various industries and companies. But just identifying the theme is not the beginning and the end. Along with the theme, we require a lot of other things to fall in place before we actually invest in a particular company.
The next is a very fun question. What is your view on the long-term performance of the US equity markets, especially given the re-election of Donald Trump? And how does it affect export-driven sectors like IT?
Sure. So, Flexi Cap has been around now for 11 years. In that, we already have had a Trump presidency, beginning and end. So, hopefully the fund will outlive the Trump presidency, and you will have many more US presidents coming and going. So, a lot of these things, GDP growth being elevated, GDP growth coming down, inflation being up, inflation being down, interest rate hike cycle, interest rate cutting cycle, tariffs being on the table, tariffs being removed. All of these things come and go. I don't think these have a lasting impact on the investment decisions that we make. Again, let's look at the individual companies that we own. We own Microsoft, we own Google, we own Amazon, and we own Meta in the US. Why have these investments been made? We are saying that digital advertising will have a significant role to play as compared to traditional advertising. We are saying cloud computing will have a bigger role to play rather than on-premise computing. We are saying generative AI will have a huge outsized role in the years to come. So all of these companies are on the right side of the trends, streaming versus linear TV, e-commerce versus physical stores. Now these are not dependent on either a Joe Biden presidency or a Donald Trump presidency. Also these companies operate the world over. They are not just US-centric businesses. So while academically we could worry about who's the president, what will be the tariffs, whether US dollar will appreciate or depreciate and things like that, ultimately it does not matter so much.
Okay, there is a related question. The US indices have done well due to a few technology stocks. Is there any sectoral concentration risk by the overseas exposure in Flexi Cap?
So I would say yes and no. One is if you lump everything, so people lump everything saying people have these acronyms. Earlier it was FANG, then Magnificent Seven and things like that, or if people club everything as a tech play. However, when you actually scratch the surface and dig down below, today something like a Google is a digital advertising company, plus it is a cloud computing company, plus it's a devices company, plus it has these optionalities. So if someone has this venture capital mindset, it's one of the best plays you can have for autonomous driving and these robo taxis on the road. So that is one part, and Amazon with its e-commerce is a very, very different play in that sense. Microsoft with its corporate IT and operating system driven businesses and things like that are different. So of course in some segments they compete in terms of cloud computing, etc. But I think there's reasonable amount of diversity in these businesses. Also in terms of valuations, a lot of these are very, very attractively valued. So the Indian IT services companies, which are very, very generic businesses, many a times those have higher valuations than these companies, and the growth rates of these 4 companies where we have invested in, those are far higher than the Indian IT services businesses.
The next question is on the dynamic asset allocation fund. A fund holding minimum 65% is considered as equity fund for tax purposes. In our DAF, we are holding about 35 to 40% in equity, arbitrage included. What is the thought process behind not moving to the 65% so that unit holders get equity taxation? In an average, arbitrage is giving about 6 to 7% annualized, and our debt holdings are giving 7 to 7.3. Is there a plan to push the DAF into equity taxation with higher arbitrage positions?
Sure. So on a sliding scale, I would say most money being in arbitrage, you have arbitrage funds. Next to that, there's a category where we are not present, but in the marketplace, there's something called equity savings funds, where the equity allocation is more than 65%. And we have DAF, which can be between 35 to 65, and if we choose, it can be above 65 as well. Why have we chosen this category, 35 to 65? And why did we not launch something like an equity savings fund? What happens in an equity savings fund is that, one, you have an advantage where your holding period needs to be only 1 year for getting long-term taxation. In a DAF, you need a 2-year holding. So, based on this holding period parameter, equity savings fund are better. But the downside in my view in equity savings fund is that you are committed to a certain amount of deployment in cash to futures arbitrage. Those yields are good right now, but there's no assurance 1 year down the line, 2 years down the line, those yields will be good then as well. In a DAF, what we can do is we can buy bonds with a predictable yield. So yield to maturity is known when you buy the bond itself, and these are 3-year, 5-year bonds that we buy. So the allocation to debt can be meaningfully higher. That was the thought process behind it. Of course, equity savings fund is also a good product. So depending on an individual's need, they can choose arbitrage, equity savings, or something like a DAF.
Okay, 2 related questions. So if you could explain the differences between the conservative hybrid fund and the DAF, and any plans to merge the CHF with the DAF?
CHF maximum equity is 25, and DAF minimum equity will be 35. So that's the biggest difference. In CHF, people will be taxed at the marginal rate. In DAF, beyond 2 years, the long-term taxation will apply. In CHF, it is permissible to have REITs and InvITs. In DAF, REITs and InvITs are not permissible. These are largely the differences. In CHF, there are investors who are grandfathered, old investors who will continue to get some tax benefit. And again, since CHF is allowed to invest in REITs and InvITs, DAF is not, I don't think merger is on the cards as of now.
Next, excluding the pharma basket, there are several stocks that have a weightage below 1% in the portfolio. Can you explain the reason for the same, as these would require bandwidth to track on an active basis?
Sure. So some of them are positions where we have been selling and they are on the way out. In some cases, there would be stocks where we would have bought with the intention of buying somewhere later as a starter position. In some cases, we would buy and the stock price runs up, in which case we are not able to add further. Various things could happen. But again, I have said this in the past, and it's a good question. It's worth communicating to unit holders. In the small cap space, which is roughly 27,000 crore market cap and below, eventually we'll have a little bit of larger number of companies in the Flexi cap portfolio, and the individual stock weightages may be lower than what we have seen in the past. So for large cap, mid cap, we'll continue to have higher weightages. In the small cap space, you could find somewhat of a lower weightage and slightly larger number of stocks. Again, just to give context, the larger mid cap funds in the industry, the larger small cap funds in the industry have as many as 225 to 250 stocks per scheme. So for them, almost every position is 0.5%, 1/4% kind of thing. So while we don't see ourselves becoming that diversified, but in the small cap space, eventually you will see some larger number of stocks and slightly lower weightages. Some of the stocks that you see right now low weight, you may not see down the road. Some of the stocks may see increased weightages. It depends on market conditions and how we are able to operate on the investing side.
Do you want to elaborate on, does it consume management bandwidth to track?
So our team has been going from strength to strength. People who came in before the session started, we were showing images of the number of colleagues that we have on the research side. So we have been adding to the research team. A lot of new listings are happening. So whether we like it or not, we will have to cover more number of companies, and obviously we can't operate at the team strength what we had 7-8 years back. Does it consume more bandwidth? Yes. Are we creating more bandwidth? Yes. Answer to both is yes.
How do you interpret the recent FII selling and retail investor behavior? Is this similar to the 1992 market scenario or any other phase in Indian or global stock markets? Also, Nifty is declining, but small and mid cap stocks aren't falling as much. In the past, small and mid cap stocks used to drop more when Nifty fell and vice versa. Now the situation is different. Small and mid caps rise more than Nifty but don't fall as much when the market declines. What are your thoughts on this?
I don't think it's an exact replica of any time in the past that we have seen. Largely, the fact that Nifty has fallen and small mid cap stocks are resilient is the nature of the buying selling. So foreigners typically end up owning larger companies, and when they sell, the larger companies are more impacted. A lot of money has flown into the thematic funds, into small and mid cap funds of mutual funds, and a lot of money has flown into PMS, AIF, small cases, all of these, and a lot of individual investors have opened demat accounts. Now these people are typically driven to small cap companies and mid cap companies. To my mind, that explains the resilience of that space as compared to the larger companies.
The next question is for Neil. There seems to have been some churn in the non-fund management senior personnel at PPFAS. Can you elaborate? Can you shed some light on the reasons for these exits? For example, CFO left.
Yeah. So obviously, as the company grows, skill set needs also change. There are obviously, we are also looking for different skill sets. Sometimes the other person is looking for a change. So again, that was kind of a mutual kind of parting of ways. Nothing to do. We needed, so again, the CFO we've got is Mr. Himanshu Bora, who's come from ASK. So we needed someone with a skill set of someone who's probably handled a larger organization. And that's pretty much why that happened. So I don't think we should look too much into it.
The next question is, what is the status of the GIFT City instruments? Would it be an inbound AIF, outbound AIF, or anything else? If you could shed some light on this.
Yeah, so one inbound, one outbound is currently the thought process. The company has been incorporated, but as I said, our separate set of colleagues will be handling that. It's a subsidiary of the holding company of the AMC. So people sitting on this dais will not be the people managing that company or managing those schemes. The inbound scheme will be a feeder fund where the GIFT City scheme will invest all the money in the Flexi cap. So for foreign investors, it becomes a convenient way of investing without having to open a demat account, bank account, getting a PAN, filing Indian income tax returns, all of that. So that's a very, very simple thing. Inbound fund of fund kind of structure or a feeder kind of structure. Outbound, any individual in India has a limit of $250,000 per financial year. The individual will have to approach the bank, pay rupees, get dollars, remit those dollars to the GIFT City fund, and the GIFT City fund will pool that money and invest in individual stocks abroad, operate a fully foreign fund structure in GIFT City. But exactly what will be the structure, what will be the details, all that will happen in due course. As of now, the company has been incorporated, the personnel have been identified, some of them have joined, some of them are in the process of joining. We will be applying for a FME license with the IFSC authority in GIFT City. So that's where we are right now.
The next question is on the research process. How do you identify a change in the story of any company, and what is the minimum holding period for any stock in the portfolio?
Just to give a background about the research process. So we have a research team which covers different sectors as individual analysts. And these analysts then deep dive into various companies from those sectors and come up with investable ideas or tracking ideas, what is happening in those sectors or allied sectors and so on. And over a period of time, as part of the coverage, you will uncover changes or trends in different sectors which get highlighted to the investment team through internal presentations, to discussions and periodic updates. So it's not necessary that we'll always have to depend on news flow just to understand what's happening. The research team also is on top of things to help us understand what is happening in different sectors that they are tracking. On an individual company basis, of course, that is the job of the analyst to keep track, keep updates about all these companies going forward. So they attend conference calls, they attend investor meetings, they will attend conferences arranged by different brokers, they will go to exhibitions, they will travel to different plants, facilities to see what is going on. Get a physical as well as a digital version of understanding all the information that is out there. And eventually that gets communicated to the investment team and we come to know what changes are happening in the industry.
The next one is probably close to my heart. What is your view on the future of India's print media sector? Additionally, how do you perceive the impact of digitalization on these companies? Can they leverage it to drive growth and profitability?
I think Neil will agree when I say this. Increasingly, we have a news media sector rather than a print media sector or a web portal or a electronic media. So these days, the people who write stories for print media are also active on social media. The newspapers themselves have very, very user-friendly apps with good UI UX. In a lot of cases, the new age customer is directly going to the app and to the website rather than subscribing to the printed version of the newspaper. There are podcasts which are done. So increasingly the lines are blurring with fake news, with generative AI. The importance of authentic news, unbiased news is increasing day by day. I don't think media is going anywhere, but there's a period of transition. So business models have to be figured out, and people have to be very clear that there has to be a monetization model, either by way of a mobile app or by a print plus digital subscription or by bundling of different services. So various people have these bundles. Mint, for example, I know they have a bundle with the Wall Street Journal and with The Economist. So these kind of deals will have to be done, and relevance I don't think goes away.
The next question is stock specific. So since we have an investment in CDSL, can you comment on whether you have considered to invest via the holding company, BSE instead? And what have been the reasons for not choosing this route?
So there are businesses which are called double side network effect businesses. Let me give a non-tech example. Since we spoke about newspapers or the print media, Buffett had this discussion many years ago, maybe a couple of decades ago. He says that in a particular city, the newspaper industry follows the survival of the fattest. So the fattest newspaper in the city will have the most content. Because the newspaper has the most content, it will have the maximum number of subscribers. Because that newspaper has maximum number of subscribers, all the advertisers will advertise in that newspaper. Because the newspaper has maximum revenue, it can employ the best journalists and editors and all of that. And again, it will reinforce the position of being the fattest newspaper in the city. It becomes a virtuous cycle, a flywheel, and it keeps growing. This double-side network effect also works in a lot of other businesses, be it ride-hailing, for example. The app with the most riders will attract the most drivers, and the app with the most drivers will attract the most riders. Ultimately, there's space only for one or two. Similarly, in the exchange business, there's this double-side network effect. So, for the longest time, our thing was that NSE would be the dominant player, and it is a dominant player, but fabulous turnaround from BSE. One is regulator did not want too much concentration, so policy-wise also they have been nudging towards evening out of market share. The current CEO of NSE again is a past CEO of BSE. Some of the turf wars have gone away. Down the road again, a listing of NSE will be beneficial to BSE. So BSE has been a great investment if one caught it. Probably it's a miss on our part. But yeah, in the depository business, CDSL is number one. And in depository, there's no double-side network effect. So if you have shares with NSDL, you can sell to someone with a CDSL account. There's no bar on that. So yeah, you win some, you lose some. So CDSL was a good pick for us. We should probably have looked at BSE also closely.
What are the reasons for continuing to be bullish about Maruti Suzuki as compared to some competitors like M&M who have done well?
So we keep tracking all the companies in the sector. So be it M&M, Tata Motors, Maruti, all of them. The only thing is that Maruti is the only play which is a pure play four-wheeler play, whereas the other companies have other businesses like commercial vehicles. Some of them even have investments in other subsidiaries of the group. So this was the only pure play four-wheeler company that was there when we invested in it. But obviously we keep tracking these companies they have missed on the SUV front, they have missed on the electric vehicle front, but it's okay when in technologies which are evolving every day, it's okay not to be the first one to be present. It's okay to learn from other people's mistakes and then go and launch later on. So again, it's not a hard no for any other company in that sector, but when we invested in it, Maruti looked better than other companies.
Yeah, Ronak and Rohil have been liking M&M as well, and they've been trying to convince us to buy M&M, and it's a good company as well. So nothing against M&M, but they have also been liking Maruti in that sense.
Several companies have been announcing demergers. Do we plan on leveraging any such opportunities in terms of value unlocking?
One of our companies is also undergoing demerger. So as we keep tracking that, as in when opportunities come, we avail of that. ITC is undergoing a demerger with the hotels.
Why have you sold significant stakes in UTI AMC, Bajaj Auto, Sun Pharma and VST Industries?
Bajaj Auto, yes, so it was largely driven by valuation reasons, but there have been a few questions around the capital market related businesses that we have sold, so UTI AMC and Motilal Oswal, CDSL and MCX and those kind of companies. So one is the Ind AS adoption, the new accounting standards that the company law and the CA Institute requires companies to follow. That has changed in the past with businesses in the capital market sector. What happens is the earnings reported have become more volatile, and people really do not understand, based on reported PAT and reported EPS, what is actually the operating earning and what is the fickle mark-to-market gains that are there. So Berkshire Hathaway also has this complaint. They break down their earnings every quarter in terms of how the shareholders should look at earnings and how the earnings are reported. All of the asset management companies, etc., will have investments in mutual fund units. Now the NAV of the mutual fund units keep bouncing around on the way the market moves, whereas their core operating business is that of either getting asset management fees or stock brokerage income or income from investment banking deals and those kind of things. Those are the core operating earnings. Capital market businesses inherently are very volatile, and Ind AS has made them even more so. While the businesses are attractive, we invested in them because we were bullish on the financialization of savings and all those kind of things. But the run-up in stock prices has been very significant, and at this point in time, depending, based on our market view on the cycle as well as the valuations, we think it's prudent to trim positions there.
So the next one you are asked almost every year, but perhaps your answer might change this year. So investment rationale for ITC, and how do you view the business after the recent demerger?
So it's obviously not as attractive as it was when we bought. Share prices moved up, but still it's reasonably valued. What was considered to be a dud business in the past, which was their hotel business, has suddenly become attractive with the rise in occupancy and the increase in room rates, and it has been an industry-wide phenomenon. Also, they have clearly announced that in the future it will be more asset light, so some of the hotels will be only on a management contract basis rather than they're having to invest money in constructing hotels. And in any case, it will be demerged, so it will be a separate legal entity going forward. So from that point of view, it's a reasonable company to hold on, and among the more cheaper FMCG companies out there. So when everything got bid up very, very excessively, ITC, because of whatever concerns around ESG or otherwise, was one stock which did not go into that overvalued territory.
Coal India has a history of poor returns and has also faced threats from the increasing share of renewable energy, yet this company is one of your highest weightage investments. Can you please explain the reasons behind this?
So, when we invest in the company, let us say we invest in the company today and we hold the company for, say, 5-year period. Over this holding period, our returns will be driven by 3 factors. One will be the dividend yield, which will be either 0 or positive. It will be driven by earnings growth, which can be positive, 0 or negative. And it can be driven by price earning multiple going up, remaining steady or coming down. A combination of these 3 things will give us our returns. Now, sometimes you could have companies, for example, some of our US companies, where dividend yield could be 0, where you see a possibility of, let's say, around 15% kind of earnings growth in rupee terms, and you see that the earnings multiple is reasonable, it will not go up or down, you could end up getting something like a 15% return. At the same time, you could have something like a mining company, something like a Coal India or some other company, where let us say you are getting a dividend yield of 6%, 7%, where you could have a 5 to 7% kind of volume growth, and you have some other optionalities. They're diversifying into renewable energy, coal gasification, or some amount of valuation multiple increase, and you could again end up getting your decent return. So while we recognize the shift towards renewable energy and we have been tracking that space very, very closely, I don't think it's something which is going to happen in next 3 years, 5 years, or even a decade. I think we'll need coal for at least a decade, and the valuations give sufficient comfort for the medium-term holding period.
At what percentage of shares of a single company does liquidity start becoming an issue? Additionally, what is the reason for not investing further in Maharashtra Scooters instead of Bajaj Holdings?
So I don't know whether Shubham is there in the audience somewhere. Shubham is our risk manager. So we have a dedicated person whose full job 365 days a year is to worry about liquidity, and not just liquidity, worry about various risk factors. So liquidity, I think, has to be looked at in context of 3 or 4 factors in conjunction. One is how much of your investment strategy depends on churn. So people who have a investment strategy which requires you to buy and sell shares very, very frequently, the need for liquidity is very, very high. So that is one factor. Second factor is client concentration. If, let's say, in your mutual fund scheme, if one client has 15% of the assets, then you need a liquidity to be very, very high. In our case, both the investment strategy and client concentration is not there. So investment strategy is buy and hold long term, and client concentration is very, very less than 2% for the number one client. So that way, we don't require frequent churning of the portfolio. And at the same time, at the portfolio level, our board of directors, trustees, risk management team, all of that keep looking at within 1 week, how much of our portfolio can be sold to generate cash, within 15 days, within 1 month, within 2 months, all these are there. And we assume a limited amount of participation, stock participation. So we will participate only up to 10% of the market volume or 15% of the market volume. We look at the number of days it will take to liquidate. So not just liquidity, there are other questions around cyber security risk or reputation risk, and each and every aspect is looked at, and people who are actually interested to deep dive, there's a very detailed risk management circular that SEBI has put out and made it mandatory for fund houses to adhere to. So I don't think any of the positions that we have are things that concern us in terms of liquidity too much. The holding company versus underlying, actually, if people have been tracking this, the discount on Bajaj Holding has come down very, very significantly. So it's now just north of roughly 40%. This used to be as high as 60-65% at some point in time. So actually, each year we get asked this question. Actually, buying the holding company has been beneficial to us as compared to buying the underlying, because the discount has narrowed significantly over the years.
Next is the investment thesis for EID Parry.
So EID Parry is the holding company for some Murugappa Group companies. One of the listed entities is Coromandel International, and we have been tracking Coromandel for a while. And EID Parry also has its own operating businesses, so it's not a pure holding company like a Bajaj Holding or a Maharashtra Scooter. And here, if you look at the valuation of the underlying company plus the operating business, whatever it is in sugar or whatever, and the market cap or market value of EID, the discount has been significantly high. Sometimes it has been even higher than 70%. Now it has reduced a little bit, close to around 55-60%. So just like we have Bajaj Holdings and Maharashtra Scooters, EID Parry gives us the opportunity to participate in the underlying group company of Murugappa Group, which is also a reputed business group in India.
What are the potential triggers for HDFC Bank? Do you think it is too big a company for its own good?
So, I think in India, in the last 2-3 years, this perception has built up that by definition, a smaller company should do well and a larger company will not do well. The situation in the US is complete opposite. There, the entire market returns are driven by what is called these Magnificent Seven companies, and the small and mid cap stocks have been languishing. Ultimately, whether something succeeds or does not succeed depends on the management quality, the business strategy, the on-ground execution, and various other factors. There's no reason why a big company will always do well or a small company will always do well. So if we take this analogy further, someone should be buying the defunct regional stock exchanges because those are small and probably NSE is too big for its own good. Now it doesn't work that way. The larger organizations have the full product range. They have the ancillary businesses like life insurance, general insurance, stock brokerage, investment banking, remittance services, all of that. They have a sufficient branch network for a diversified deposit base. So in fact, the tech spend of a large bank and a small bank will be almost equivalent for the kind of security protocols and the kind of core banking solutions that have to be provided. Now, if a larger organization is able to leverage that expenditure and spread out the fixed cost over a large number of customers, actually it results in improved margins. So I don't see a reason why HDFC Bank being big by itself is a disadvantage.
Meta, Alphabet, Microsoft and Amazon are now more capex driven due to high AI investments. Does that affect the original thesis that these businesses require less capital and thus provide high returns on capital? Additionally, they are trading at high PE multiples. Are they overvalued?
So all the four companies, I fully appreciate that the capex has gone up, but again the nature of the industry has also changed. And because these companies, all four of them generate such substantial cash flows from their existing businesses, they were able to catch these trends, they were able to invest in these trends. And a trend which includes, one is cloud computing, second is the trend of having data centers which can do AI computations and create these large language models. And thirdly, to have a thriving business along with that to keep generating cash flows. So the question is quite valid that the ROC of these companies will get affected because of these more capex. It's not just the ROC, but eventually even the reported earnings will get affected as depreciation comes into all these investments that they have made. And more importantly, what you should track as investors is not the ROC on the past numbers, but the return on incremental capital that these companies will generate. So if you do not invest, if you do not have the product or the capability of participating in newer trends, you will not be able to even offer a product. That is number one. And number two, whatever product you might have will be under-invested in R&D, which again is not competitive, and some other players will take away the market share in these categories. So from all these points of views, I think we have to balance between what is the incremental return that they will generate from these investments, which will be slow in the initial years as the capacity will get used. But in this case, it has not been the situation where all the investments they have made have been immediately deployed, and the investments have had very, very decent returns compared to their existing businesses. So that situation has not come yet where the ROIC is getting impacted because of additional investments. To differentiate with other companies like Amazon and the other three, which Neil mentioned, Amazon also has a thriving e-commerce business which has required substantial investments in creating these fulfillment centers or last mile delivery centers to do quicker deliveries to their customers. And that has actually seen a ramp up in the customer adoption and even the percentage of e-commerce business versus the overall e-commerce market versus the retail market in the US context, because that number is tracked very closely over there. So all these trends are firing in the direction which is favorable to all these companies, and so far the return on capital has not been affected despite these investments, but we monitor it very closely.
What is the investment thesis for Kotak Bank, and how do you view the transition of the top management after the exit of Uday Kotak?
So in the banking space, virtually every large bank has gone through management change. We have had a management change at HDFC Bank, we have had a management change at ICICI, Axis, Kotak. PSU banks keep changing the MD every 2-3 years. I think the way the banking industry is structured in India is that by design there's not to be any over dependence on one person. Even if that person is a significant stakeholder in the bank. I think the organization finally is bigger than the individual. I don't see the bank having too much difficulty. In any management transition, there is a period for the new person to settle in. It could be 3 months, 6 months. Sometimes it could be as long as a year. I think things will be more or less business as usual. Rest of the staff remains the same and people will continue doing what they are. So after the change of the CEO, there was some churn. So another key person left after that to head another private sector bank. But that is to be expected when someone from the outside is selected and someone is bypassed. But I don't think in such a large organization it matters so much.
Why do we continue holding Wipro despite its fundamental underperformance to its peers over the last few years?
So IT companies have a very, very unique way of being very sticky in terms of the cash flows they generate. And if you have seen the IT industry in the past, there is a pecking order of valuation, or it used to be, it has changed now. But you would see the larger IT companies, the top 4 at least, Wipro, TCS, Infosys, and even Tech Mahindra, which used to be larger at one point. These companies used to trade at a higher multiple, followed by your mid-cap IT companies, and then followed by your smaller IT companies, which had choppy growth rates. That situation has reversed. Mid-cap has become much larger now because the growth rates were faster. Whereas large caps have stagnated in their growth rates to some extent, and they haven't been growing at the same rates as they have in the past. Now, if you see companies in the top 4, Wipro has been struggling to maintain that growth, and I fully agree that it has not been performing to the level of investments that they have made or the kind of business that they run as compared to other larger IT companies in their peer set. And hence, if you have seen the portfolio, the Wipro's percentage allocation has kept on declining, whereas other companies we have been adding more actively. So it remains to be seen. So far, the business model for Wipro has not changed. It still remains a cheaper way of owning the IT industry basket. But Wipro, as such, we keep tracking, and if the performance remains to be lagging over a long period of time, of course, we will see what to do about that stock at that point.
The pharma sector continues to be a low weight sector despite basket approach. What is our view on the sector?
The fundamentals of pharma sector have not changed. So the reason why it used to be a basket approach and not to bet too heavily on individual companies, that has not changed. On the other hand, there has been a lot of action in the ancillary or the API side or the contract manufacturing side in terms of companies showing a spurt of revenue growth, spurt of profit growth, and the valuations have gone way beyond even the larger companies. And even if you see the generic companies, their domestic parts have done far better, and the earnings have also caught up. And consequently, the valuations have gone up. So it's not a very, very attractive time to participate in pharma companies today. So as and when some interesting company which meets our criteria to go in the basket comes up, we will consider it. But so far, these are the companies we are stuck with, which are doing fairly okay.
Next one quite interesting to me as a mutual fund investor. Would the smaller AUM of the tax saver give it an edge over the Flexi Cap fund?
Hypothetically, let us say if I were to answer yes, what would be the reaction on Monday? Everyone would redeem Flexi Cap and put money in tax saver, and then we will have the same problem in tax saver. So people say, I'll take the question further. You have just asked about tax saver. I'll take the question one step further. Why don't we launch a new mid-cap fund or a small-cap fund? You have difficulty in a larger fund. If there's in the smaller fund, you could do better. If that were to be the case, all of us will run to the exit door in Flexi Cap. We'll again stampede into the new scheme. That will become larger. And again, the same thing. So the tax saver fund and the Flexi Cap fund, we follow the same investment strategy. The portfolio, as far as the Indian stocks are concerned, are more or less identical. There are certain nuances. Tax saver has to be minimum 80% invested at all time, as compared to 65 in Flexi Cap. So tax saver is minimum 80, Flexi Cap is minimum 65. Tax saver cannot invest abroad. Tax saver cannot do any derivatives. So cash to futures arbitrage or covered call, all those things are not permissible in tax saver. So my recommendation is anyone who needs ELSS benefits should go to tax saver. Otherwise, Flexi Cap is good enough for most people.
Long-term bonds will enable us to lock high interest rates and avoid reinvestment interest rate risk. Why aren't there too many long-term bonds in the Parag Parikh Dynamic Asset Allocation Fund?
Mansi, you want to take a go at that?
Long-term bonds can be very volatile in a short term. In Dynamic Asset Allocation Fund, we invest in short-term CDs, medium-term bonds, and also 6 to 7 year SDLs. We maintain a duration of 3.25 to 3.5 years. While we adding a long-term bond, investor will get scared with the volatility because they are more volatile due to the interest rate changes and other things. So we aim to maintain the medium-term duration for our Dynamic Asset Allocation Fund.
Okay, next one is also fixed income related. How does the Flexi Cap fund decide between having arbitrage and CDs for the debt holdings?
Yeah, I'll take that probably. Essentially, it's driven by what returns we are getting. So,
what is the criteria for the bond portion of the DAF? Is it only buying bonds at the steepest part of the yield curve to maximize term premium? Will the fund consider increasing the holdings of AAA medium-term corporate bonds like PFC, HDFC, etc., and of the spread between those, and if the spread between those and SDLs widen?
Corporate bond yield curve is inverted at this time. That is, short-term bonds are yielding more than the long-term bonds. Due to a huge demand by the insurance companies, provident funds, the long-term corporate bonds are yielding even less than state development loans. So we decided to invest in the medium-term corporate bonds where the spreads are very attractive, and we'll do long-term bonds whenever the spreads are enough to take the long-term risk.
So again, just for context, Mansi has a certain stage fright, I think. She talks very well in internal meetings. So bank CDCPs are at 7.5 and treasury bills are at roughly 6.5 or thereabout. So at the very short end, there's a big difference, almost a percentage point difference in yields. And like Mansi mentioned, when it comes to 5-6 years, actually corporate bond yields are lower than state development loans. State development loans are sovereign, they are zero risk. So they are backed by the government taxing power and the budget. Now logically, corporate bonds which have a default risk should yield you higher. So like Mansi explained, we should not be buying corporate bonds at yields lower than SDLs in the 5-year, 6-year kind of bucket, 7-year kind of bucket. And at the short end where the spreads are very, very attractive, that's where we are buying the bank CDs or the AAA PSU corporate bonds.
How do you think of the regulatory risk for companies like IEX, Coal India and Power Grid? How do you typically navigate investment decisions when there's increased government regulation in a particular sector? How do you mitigate this?
I think government regulation is a way of life with everything that we do. Like there are private sector hospitals, there's a case in the Supreme Court asking for regulations on every procedure that is done, price regulation on that. There are regulations on tolls. So toll for exiting Mumbai has been abolished. Now there are private toll operators. Those people are affected. There are private sector airport operators which operate under the regulatory environment. Fintechs, we saw RBI having a regulation and the entire business model going awry. So I think one has to live with regulation. One has to take care of the risk by adequate diversification, by portfolio weighting and things like that. I don't think one can wish away regulatory risk in any area, be it PSU or non-PSU.
Is the position in Bajaj Holding a reflection on your views on the underlying business, or is it optimism around the entire Bajaj group? What key factors do you consider when valuing a holding company? Are there specific metrics?
We are excited by the underlying companies. That is the starting point. Typically holding companies, we will want a very, very high discount to the underlying. At low discount rates, we would stop buying the holding company. We would then rather go for the underlying company.
Can you please share your experience from the experiment of long-dated options? Is it possible to scale it to 3 to 5% of the portfolio, especially on steep market crashes?
Yeah, it's a bit technical, so I don't want to confuse the audience too much. I'll just take a minute explaining this, and maybe if Rukun has a better explanation, he could weigh in. Largely, you would have seen some call options for December 24 in the portfolio. Now, as an equity investor, you can either buy, let's say, a Nifty fund, where if the Nifty goes up, if Nifty doubles, your NAV will double. If Nifty falls by half, your NAV will fall by half. That is one option. Instead, if the call options are very, very cheap meaning depending on the interest cost, implied volatility, a few calculations go into this. But if Nifty options are very, very cheap, instead of buying the Nifty stocks or a Nifty fund, you can keep money in the bank. You can keep money in money market instruments and only buy the Nifty option. Here, if Nifty doubles, you will get double on your overall portfolio, which is option plus your money market instruments. And if Nifty falls, you don't care because your money market investment is anyway protected. So that was the basic underlying approach. Nifty options were very, very cheap at a point in time. Can it scale? For it to scale, the long dated option volume has to go up significantly. I don't think there's much volume that happens right now. Rukun, anything you want to add?
Nothing to add. What was the rationale for the investment and the exit in Accelya Solutions?
So Accelya is a very interesting business. It's first of all very hard to find a company in India which is in the product space, which is in the industry which is growing. And one of the products that they offer is for airlines to manage their ticket bookings. So it's called revenue management product. It is not the only product in the market, but it is only in the listed space in India that product existed. And the product has done very well in the past and even currently keeps doing well. And if you see the margins of this company, the cash flow that the company generates, it is quite amazing. Now, Accelya parent group is a Spanish group which is owned by private equity, and that parent company is not listed. This is the only listed subsidiary of that company. The company also has an unlisted subsidiary in India which does services work for the parent company. Now, my understanding while looking at this business was that this company does provide a valuable service, has some longevity to it. But one mistake I made is understanding the new changes that are happening in the ticketing system that most airlines are now investing in. I don't want to give technical information to because it's too boring, but to avoid jargons as well. But there is a new way of ticketing that is coming up where most airlines are investing in those technologies, whereas the older way of doing things is changing. And where in the future maybe it will happen that Accelya India may not benefit in that trend because the parent company already has a new product and that may not come to the Indian subsidiary. There are a lot of questions around what will happen, and it just felt prudent to take a step back, study it again, acknowledge my mistake, and remove the company from the portfolio.
You might have a one-word answer to this, but if you want to elaborate, you can. Do you think PPFAS missed the bus by not investing in NVIDIA?
I have a one-word answer and I have a 300-page essay also, if anybody wants to understand. The one-word answer is yes, I missed recommending NVIDIA. And there's a very simple reason to it in my view. Maybe it is stupid in hindsight. But when I looked at AI or the space that NVIDIA operates in, I looked at it from the way the industry is structured. One is the infrastructure layer where all these hardware companies like NVIDIA operate. Then there is the middle layer where all these companies are making the AI models and designing AI integrations on top of this hardware. And then there is the software layer where companies and individual users of software get exposed to the AI. So you would have seen in WhatsApp there is a Meta AI which everybody can use. That is again the individual surface given to you as a user interface given to you to interact with the underlying investments that Meta has made in AI. Now my entire understanding was that the infrastructure layer should not get valued at such a level because it is not as valuable and some other competitor will come in if one company has done too well in this space. My fundamental assumption was wrong because the infrastructure layer also has a software component to it which NVIDIA does very, very well, and because of which it has been able to retain its market share, grow its market share, and essentially at a company of that size it is unheard of to double your revenues and profits year on year at such a pace. So that was the mistake. Second mistake that I made was to misunderstand that this is a cyclical trend and can go away. Again, like I said, NVIDIA's offerings were far superior than the rest of the competitors by a huge margin, and NVIDIA keeps doing well. So yeah, long answer, yes, it was a miss. Short answer, yes, it was a miss.
Rationale for selling NMDC?
So NMDC operates in a business which is by nature cyclical. These are not businesses where you hold businesses for 10, 15, 20 years as a compounding machine. Basically, the iron ore prices keep bouncing up and down, and the margins and profitability keeps going up and down. Our buying rationale was that one, we were buying it when the cycle was low, when iron ore prices were low, profitability arguably was a bit subdued. But at the same time, they had spent a very, very long period of time creating this NMDC Steel, their subsidiary. And that subsidiary was being given zero valuation. whereas it was announced that a demerger will happen and people will get free shares of that company and all of that. So after we bought, these things played out, the cycle turned up a bit, the demerger happened, we were making decent profits. So it wasn't a buy and hold for a decade kind of investment in any case in the first place.
Why do we own Maruti Suzuki, especially in light of the EV threat from the Chinese who would disrupt the market if the regulatory barriers are lifted?
EV is a threat, so this question will keep coming up today, 3 months out, 6 months out, maybe a few years down the road, whether it's four-wheelers, whether it's two-wheelers. Will incumbents be able to ride the change wave? Will new entrants disrupt the whole thing? Now, EVs are coming, that is for sure. Should you buy Bajaj and TVS and those kind of companies, hero kind of companies, or should you buy Ola Electric or Ather? Ather, of course, is again owned by Hero, but should you buy something like a Ola Electric? In four-wheelers, should you continue to own Maruti and buy something like a M&M, or should you say the likes of BYD and MG and Jindal and all these people will come and take it over? I think only time will tell. One has to keep watching the market developments. As of now, the market has not completely shifted. It's early days for EV yet. Incumbents also have transition strategies. They are also creating product offerings in the EV space. The newer players are losing money right now by being too aggressive. So it's something of a wait and watch. If it is required, we will take portfolio actions as and when situation demands.
So the next one is a classic for Neil, one that he's probably got every single AGM. What is the succession plan in case Rajeev wishes to retire?
Yeah, so I think next time I'll just add this in my presentation, this question. I think first of all, as you can see, none of us have white hair. The only person who's graying here is Ronak to a certain extent. So yeah, I think, I don't know about retirement. I think we all have ways to go, years to go, probably decades to go. Obviously, so that's on the retirement front. I mean, obviously, life is uncertain, as we all know. Things can change, things can happen. And yeah, I mean, what we can do is that we have alignment of interest in terms of, yes, we all our investments, all ours, I'm talking not only Rajiv's, but everyone here, investments are in PPFAS mutual fund, because I know that because we disclose it online, so I know how much anyone has invested in our funds. Obviously, we've given ESOPs where everyone owns a part of the company, so I think that is also there. So you're an owner of a company, you get you get your salary from the company and you invest in the company, you know. So I think we are well aligned on that front from a financial point of view. I mean, and that I feel is a smaller part of it, you know. I think the bigger part of it is, do we all enjoy each other's company? Do they have the freedom to run the fund as for the strategy? Are we all on the same page, you know, in terms of how we see the organization moving forward, how we see the fund getting performed in terms of scheme launches or what have you, any nitty-gritties, are we on the same page? I think so far we all are on the same page. So I don't see any retirement as of right now, but that's for them to actually answer and not me. I can just say that, yeah, I think we've built a relationship that is past professional, you know. I mean, so I would hope that that is there, and he's been here for 25 years now, I think 25 years. So hopefully another 25 years at least, I'm thinking. I know, Rajeev, you can probably add your own bit.
To the person who has asked that question, I'm a bit offended. I like the last year's version a bit better. So the phrasing for the next year, the proper question is what happens if Rajeev quits and joins another AMC or starts a PMS or starts a new AIF. That helps. That's a big help in salary negotiations and all that. Saying what happens if you retire is only giving him ideas. Please refrain from that.
Okay. Mr. Parag Parikh, in his book Stocks to Riches, makes a considerably strong case against open-ended mutual funds. These restrictions are there to safeguard investors, but are also hindrances for fund management, especially to take large bets when the odds are in the fund manager's favor. Do you think it is time to bring back the PMS service or do close-ended funds? Do you intend to launch a fund in the new asset class proposed by SEBI with the 10 lakh minimum corpus to bridge the gap between MF and PMS, and how to get that extra edge for investors?
So, a lot of people ask this question. So, Parag Bhai's book was at a particular point in time at a particular tax regime. So, at that time, dividends were tax-free, long-term capital gains were tax-free, short-term tax was at 10%, and at that time it was felt that diversity of managers and having that flexibility would be a great help. Today the environment is very, very different. So Parag Bhai himself felt that mutual fund would be a better vehicle, and in 2013 we launched a fund structure. This new asset class is interesting. We'll wait for the final guidelines. The SEBI board press release announced that it had been approved, but we haven't seen the final guidelines, what is permissible, what is not. And as and when final guidelines come out, and if there's some differentiated product that we can bring, and if we are excited to invest our own money, sure, we will do something on that front. As of now, nothing. So we are waiting for the final guidelines to come in.
Okay. The last question from my end, it's not in the list. It was asked last year, so I'm going to make it a classic. When is the IPO coming, and do unit holders get allotment in that?
So, never say never. That's the first thing. But obviously there are no, as of right now, no plans for an IPO. Honestly, we don't know if we have the money, what we'll do with the money. I mean, it's pretty much of a operational leverage business where as you grow, your expenses don't grow that much compared to the revenue, and everything flows to the bottom line. Yeah, obviously if we have certain plans of, say, expansions, different businesses, where we probably need to raise some capital, then we'll definitely probably will come out with an IPO or something like that. But as of right now, at least for the next couple of years, I don't see ourselves doing anything. But we keep talking about it internally, and we'll keep chatting. And if anything we can also do for the unit holders, if we ever come to that situation, we'll figure it out. I mean, we've not thought that far out, but yeah, never say never, and we'll see down the road if that happens.
So Neil, your question each year has created this interest, and employees are now getting unsolicited bids for their existing shares, and some sort of a secondary market seems to have developed. Like there are portals which are quoting prices and things like that, but like Neil said, nothing on the horizon next 2-3 years.
Thank you very much. We can now open to public questions.
There are 2 mics, so whoever is interested in asking a question can, in the aisle in the center, we have 2 mics, so we'll alternate between the 2 mics. The gentleman in the blue t-shirt can start.
Thanks, Rajeev. Am I audible? Okay. 2 questions. One is China devaluing yuan, China unleashing a lot of money in the economy. I know managing those through investment strategies, but do you see a significant impact likely to the Indian market? That's one. And the second one is, it's more operational or executional. SEBI recently said that the holdcos have a lot of discount, and they said that they will have one-day trading. That wasn't very clear. Would it really mean that on that particular day the discount goes away? It happened, but nobody came to know. If you can just enlighten us about it. Thanks a lot.
Sure. The second question answer is very, very simple. It's a enabling mechanism. If the promoters are interested to do something about the holdco, if they are not interested, the status quo remains. So in the holdcos that we are invested in, effectively there was no impact. So on that day, there was an attempt at price discovery and nothing happened. So the shares continued to trade at the earlier prices. As we spoke about Bajaj Holdings, the discount has narrowed, but not because of the new trading mechanism. It has happened on its own. China currency moves and all, I would say partially above my pay grade. I don't really have too much insight to share. Things are very, very fluid. At one end, currency rates are moving. At the other end, tariff and non-tariff, both barriers are being put in. So, currency move may shift the trade dynamics. At the same time, tariff measures may shift the dynamic again. One thing which is very clear in the last 3, 4, 5 years is that increasingly the world is moving towards protectionism. So any business strategy which requires the company to dump a huge amount of its production in a foreign country, that has a lot of risk. So every country is trying to encourage domestic employment, domestic production, and all of that. India is well placed in that, given that we have a large domestic market of our own. So we'll see how things pan out. But I don't have anything insightful to say on the currency moves of China. Thank you so much. Yes, please, at the front.
Hello, sir. Good evening. My name is Anshul. My question is regarding Intel. Right now, it is facing a lot of heat. Their fabs are not working properly. Snapdragon offered them to acquire them. They have 10 fabs valued at 10 billion each, so 150 ka valuation. But they are like currently trading at a cheap level. So what do you think? Can we buy it, like slash some foreign position and create a position into Intel?
So Intel has had a great...
I also have a second question, but I'll continue later.
So Intel has had a phenomenal history in the semiconductor industry where they pivoted from memories to computing chips. And the next pivot, which was supposed to be happening to mobile, which I think they bypassed because at one point did not have the products ready and R&D did not go over there. It went into servers. Now what has happened with the overall computing structure, there is a fracture. One is the servers keep doing well. On the other hand, you have GPUs which are powering the AI workloads and you don't need traditional servers to do that work. So on the traditional part, Intel does have currently a significant market share, but this market doesn't evolve that way. People who make future investments need to see a product pipeline and a product profile which is there for the future needs of what they're going to invest in. And so far, incremental dollars are not going towards products that Intel has. Unfortunately for Intel, they have been hit by two different problems. One is on the foundry side where they make their own chips. That the industry has already moved to an outsourced model where some other people who have become extremely efficient at making chips, they are making chips for other players, where Intel has suffered in maintaining the technology curve or the expertise curve. On the other hand, I said the products are not there yet for them to gather any future interest. So we'll wait and watch because this is a highly volatile market today in terms of chips that they are offering. We'll keep tracking it, but so far it doesn't look very, very promising in terms of how the cash flows, new cash flows will be generated in the future. But like Neil said, never say never. Keep testing it out and keep seeing where the business is growing.
Okay. And my second question is regarding Biosecure Act in US. Like 8 December, it was not presented in NDA. But apart from that, many Indian API companies are expanding their capabilities, like Suven is like merging with Cohance. They are trying to acquire new API companies across the world. So India is developing that capacity. So if may not, Biosecure may not realize, but India is developing capacity for APIs. So like we have very limited exposure in pharma. Can you shed lights on it?
So many companies we already own have a supply chain which they supply their own APIs to themselves. In some product categories, they rely on external vendors for API. So that from that point of view, they are vertically integrated. But on the question regarding India's API space, there is a lot of demand. And I think from future security of medicines, I think India should have its own capacity. but the pace at which capacity is coming up is a little slower than one would expect. I think we should track this industry, and we are doing it at the moment, trying to study different companies. And again, the question is not just about the opportunity, like Rajeev said, it's about the right quality of management, right quality of business dynamics, diversification of cash flows that the company has, and in the end, the right valuation we will pay for it. So it's a space that we keep tracking very closely.
Okay, thank you.
At the back, please. Yeah.
Hi team, my name is Hussain Mansi. Welcome to the team. So for anyone on the team, this is a question about, I think, fund thesis. Now, you know, I give it to you fully that you guys have never branded yourself as an ESG fund or anything of that sort. But internally within the team, I was just curious to get your understanding on climate change, fossil fuels, etc. At least when there's an immediate perception of a certain company, let's say Coal India, let's say ITC and tobacco, something that is negatively perceived, what does the team think about it, and how do you think about future investments given this view?
Sure. Thanks a lot. So ESG has 3 letters in it: environmental, social, and the governance part. Governance as it is, even before ESG came into fashion, we are very strong on evaluating the corporate governance of a company, and we don't want to partner with companies which defraud the government, or which cheat the customers, or which are continuously in the news for wrong things. So governance anyway has been a part of what we do. The E and S part, obviously we don't want to be net negative to the society. It's not that we start out saying that we don't care about what happens to the world as long as we are making money. That is not the approach. At the same time, we recognize the fact that business is not black and white, and there are shades of grey. You specifically mentioned ITC. I don't know whether you have read the annual report of ITC, and ITC gets itself audited on ESG parameters by various external agencies, and actually it scores very, very well on ESG factors, because they have all these e-chopals, and they have all these farmer benefit programs, and they have reduction of whatever plastic waste, or using renewable energy, and what all. Of course, we know that tobacco is harmful to the customer, and that's the big elephant in the room. To the extent tobacco is harmful, government taxes it punitively, government bans advertising on it, and ITC itself has been transitioning itself from a company which probably derived 100% of its revenue someday from tobacco and cigarettes to a company which is now less than 50% revenue from tobacco and its derivatives. Coal India you mentioned, all of us would love for the air not to be polluted and to pump less carbon dioxide in the atmosphere. But at the same time, we can't ignore the fact that the auditorium that we are sitting in right now, and I am talking on in a microphone which is powered by electricity, at the other end some coal power plant would be burning to give us this electricity and air conditioning. So many a times people do what is called greenwashing. They will probably buy electric car saying, oh, I am so environmentally conscious, but the charging will be happening by a coal fired plant. Business, society, government, courts, all of us have to work together to work on the E and S part. Ultimately, every company will have some environmental footprint or the other. We look at things on what they are doing to transition and to minimize the impact and effectively do good for the society, but it's not a 0 or 1 kind of situation. It's not that we will buy Tesla and we will sell Coal India, whereas the Tesla is getting powered by Coal India somewhere. So we are not naive in that sense. We accept the world realities.
Okay, so to maybe put it another way, is there a sector that you would completely stay away from, just as a fund thesis?
I don't think there's a hard and fast thing on a sectoral basis. We look at it company by company as such.
Okay. My last question is on probably lump sum versus SIP. And maybe you've answered it, so apologies if there's repetition. But I was just thinking that because I'm an investor in a fund like PPFAS, I believe that, okay, you should be patient, you should wait for the right opportunity. But as a regular investor, SIP is usually what most of us do. Now, when there are crazy bull markets, I would end up investing in a value fund, even though the NAV is really high. So, as a regular investor, how do I get the benefit of your thesis and your thinking? Just what do I do?
If you are doing your SIPs, continue with them. We will take care at our end what is worth investing in, what is not worth investing.
But doesn't the higher NAV in a bull market kind of negate that?
Logically, you should expect higher NAV over time. So, if we are doing the right things, 5 years from now, NAV should be higher than where it is today, and 10 years from now, it should be even higher. So,
okay, thank you so much.
Thanks.
Everyone just keep it for one question per head, and then because there are quite a few people who want to ask questions, so the second question can come back later. Thank you.
Yes, please.
Yeah. Good evening, sir. My question is, though we very clearly heard that there is no pipeline for, there is no new fund offer as it is going to be, but the Parag Parikh is quite resourceful and quite a trusted, and we would really look out for a global fund to come out, because there are so many global companies which are, we will get you guys will be able to capture them. We are hardly able to know about our own stock market rather than the globally. So a global fund where we can just invest our money like Parag Parikh Flexi fund and leave it for quite a significant time would be really helpful.
Yeah, we would love to come out with such a fund. Currently, the constraint is RBI limits, so it cannot be run as an Indian mutual fund. That's where we are working on that Gift City fund, which will effectively be a global fund investing overseas. But it's that the RBI limit is constraining each and every mutual fund in India from global investing.
So just one more question. There are, in case somebody wants to transfer their stock portfolio, they want to liquidate the stock portfolio to mutual fund portfolio, which is the right time, the bull market or the bear market, or what?
From a taxation perspective, bear market is better because everything is lower, but otherwise there's no such time. Thanks.
Thank you, sir.
At the back, please.
Yeah. Hi, sir. Good evening. My name is Abhishek, and my question pertains to banking sector. So I have seen, there is in PPFAS around 18% share of banking stocks. So the question is, do you still find banking sector generating the kind of returns which they were doing in the last let's say 3 years back or 5 years back? So in fact, in the large private sector, the returns have been abnormally very less compared to the last couple of 3 or 4 years. Now, so question remains is, do you still find, the mid-sized public sector bank space you have not invested in? So any specific reason for the same? And how do you think the things are spanning out in the next, let's say 6 months down the line? Thank you.
So banking sector is one of the few spaces where the entry is restricted, where people cannot freely come in and start a banking operation. RBI is very, very stringent in terms of handing out new banking licenses. Also, it's a business where even if you start a bank, you may not have the opportunity to own 100% of the bank. So RBI forces you to dilute your stake and have only a limited management control. As we saw in the case of Kotak Bank, the founder had to step down from the CEO position. So the attractiveness for people to rush into to set up a new bank is that much limited. Largely you have a handful of banks which have the technology, which have the complete product range, the branch network rollout, the capital base, everything which is there, the ancillary activities in terms of asset management, life insurance, health insurance, stock brokerage, investment banking, all these activities. So these 4, 5, 6 banks are there which have all of these things with them. So it's better to invest in them where they are running a very, very profitable operation and where there's very little risk of ceding market share. In fact, they've been gaining market share from the weaker players. Plus, as the economy grows, the banking sector grows in line with the nominal GDP growth, which is inflation plus the real GDP growth. That is more or less the money supply growth that is there. So it's an attractive business. I think last few years stock prices have been subdued, but banks have been doing the right things and I think they are well placed. In the public sector bank, I think something like a SBI Group has the entire product range and the technology background and all of that. A lot of the mid-sized PSU banks have faltered in terms of the digital applications and the customer service and allied product range and all of that. So our preference continues to remain with the private sector banks.
Yep.
Thank you. At the front, please.
Good evening all. So Rajeev sir, to watch and interact with you, I have cancelled my movie and other plans for today.
Thank you so much. I hope your family is not too upset with me.
Yeah, they are upset.
Sorry to hear that.
So sir, means I have watched your interview on psychology, investor behavior and other perspectives, so that helped a lot. And my question is, sir, now in your opinion, how you see the US market? They are trading, means Nasdaq trading above 40 PE, and if there is crackdown, so what is the impact in our markets there?
I don't have a very strong view on the entire market because we don't cover each and every company listed out there and don't have a view. I think the companies that we own, we are reasonably confident on the prospects of those companies going forward. Overall, the chip manufacturers, Ronak spoke about the prospects. Again, see, Ronak is slightly being harsh on himself when he says we missed out on NVIDIA and things like that. So let me take you back in time in where earlier MacBooks used to run on Intel chips and then they decided they'll run on their own chips, Apple designed chips. Now this happened in a very short span of time. So these are B2B transactions. Now when will Apple stop buying Intel chips and when will they create their own chips? Very difficult to know as an analyst. Now today everyone is excited about NVIDIA's chips. Now Google has their own version of TensorFlow chips. Now at least speaking for myself, I don't know about Ronak, but I have no competence in terms of understanding how long this demand shortage scenario for NVIDIA's AI chips will continue and when competition will pick up and when the switch will happen. So to answer your question, we don't have a view on each and every Nasdaq company which is listed out there, or I don't have a macro view on US per se, but at least the companies that we are owning, we are reasonably confident on the prospects of those companies.
Thank you, sir.
Yeah.
Since you mentioned the PE of most companies, I think that may be an inaccurate metric to use because many of the Nasdaq companies are under severe investment phase and PEs might look inflated because the stock prices have not corrected but the earnings would have suffered because of the investment. So PE may not be the right metric and each company should be evaluated individually for what valuation metric you look at. But I think mostly a free cash flow yield kind of a metric is a better yield if the business is stable and growing their cash flows.
Thank you, sir.
Hi, good evening, everyone. I love the fact that you have a risk management team, and I think you have a dedicated person who looks at risk. My question is, since the past couple of months, since the past couple of years, in fact, the SIP amount getting invested is only increasing. Is there a threat that if any trigger comes and if the SIP amount starts reducing, it can lead to a panic sellout and redemption in the mutual fund portfolios as well? And a second slightly related question is, as a stock portfolio, when we look at market volatility, our heart goes up and down. Is that the same in the mutual fund, in your mutual fund office as well, depending on the increased volatility? Thank you.
Yeah, so the volatility of inflows and outflows, it's been there for centuries. I don't think it's new. People rush in to buy when markets are strong. If market goes through a downturn of 3, 4, 5 years, people lose excitement and inflows come down. About SIPs, given demographics of India, where more people join the workforce each year than the number of people who retire each year, we are a young country. In such a scenario, I would expect the savings and investments to increase as such. We are not a country with a very old demographic like, let's say, Japan or something like that. So I would expect, barring the cyclical upturns and downturns, I would expect the SIP book to grow over the years. At the same time, capital raising will also increase. So it's not that the existing number of companies will be there and SIP money will chase only limited number of stocks. You will have more IPOs, you will have more QIPs and more listings. So both will go hand in hand. Speaking for myself, if there are many days where I am in some internal meetings or at some event, or I'm reading something or doing deep dive, and at the end of it, I don't even know whether the market was up or down. And when I reach home in the elevator, if someone starts talking about the market, I'm a bit embarrassed, because that person precisely knows at this point index was here and then it started moving up and it closed here, and I have no clue whether the market was up or down, and I have not looked at the screen. So I think we have seen enough ups and downs. In 2008, at the index level, the market was down some 60% from peak. These 1-2%, 3% up and down doesn't bother at all.
We don't have TVs in the office to seeing the markets. And all.
Dealing room has, so those people are entertained.
Again, there was only 3 or 4 people. Nobody else has access to that also. Risk management.
Thanks.
So I have an observation to share here about the culture at PPFAS, and I've been around for almost 16 years now to attest that every day it is followed that way. Is that if you come to the office of PPFAS for any work or to meet somebody, you would not know whether the market is up or down. That's for sure.
Thanks a lot.
At the front, yeah.
Hi Neil and Rajeev. Aaron from Mangalore.
Hey.
And a very stupid and simple question to you guys. Most of the AMCs have come across, asset management companies. They run active funds which are total bullshit. They have a weird kind of marketing tricks, and I don't like them because of their nonsense. My personal investment philosophy is throw money into the Nifty 100 fund and throw money into the Nifty 50 ETF, which has the lowest total expense ratio. So your PPFAS was the first AMC I've come across to invest active category. I've been investing in passive funds, and I'm not a major to invest. I invest my mummy's mutual fund account. So the simple and stupid question is, most of the AMCs are heavy on marketing, NFO, this, that, and insurance companies selling these ULIPs, all kind of bullshit, which you are aware of. Everybody here is aware of. And they're making big money out of it. Whereas you are ओके ठीक है, दिस इज आवर बाउंड्री, हम इससे बाहर नहीं चलेंगे. So आपका फर्क ही नहीं है क्या इस पे?
I think
and these people are making good profit out of it. And I've been to AMC sessions. कल नींद नहीं आएगा इनका सेशन गया तो. So yeah.
Yeah. So I think one thing is pretty underrated today in our lives, and not only in market and all, is being content. You know, sometimes we talk about being content. People think it's laziness or there's no drive or any of those things. You know, but sometimes it's just fine. You know, so we have, again, we get paid well. I don't think we are under the curve in that way. We make enough money. We get a good night's sleep. Yeah, I mean, we're happy in life. We go home at 5 p.m. We come to work when the markets are on, and yeah, it's. I think the main thing is to not create more stress in our lives. So the more schemes they have to run and the more NFOs we have, it's more stress for the whole team. And to just have NFOs upon NFOs, which again have no differentiation or just for AUM gathering, it actually will, it's counterproductive to us. We will be in office later. We will not able to spend time with our families. We will not able to do any hobbies we want. Saturday, Sundays are pretty much relaxed. And again, I think it's a balanced life. I think what we're looking for also when we work, having a professional company and all, is having a work-life balance for everyone. Where we don't want people to be stressed out. I think you have one life, be content, be happy, live yaar aaram se.
So you have never felt okay, AMC छोड़ूंगा LIC भेजूंगा, because there is, have you never felt okay, I'll quit everything and I'll start selling insurance policies and other products because these are giving you high commissions. And I'm also against these products. I don't like this.
But that's not how we are internally wired. I mean, when we say that we want to be the most responsible and most trustworthy, that's our vision, then doing all these would actually take away from anything that we stand for, you know. So in the end, I won't be happy. None of them will be happy if we start doing these things which are not where we are not internally wired to.
Okay, I trust you with my money. Thank you.
At the back, please.
Very good evening to the entire team, sir. So my name is Kash Solanki. My question to you pertains to real estate sector. Okay, we know that the real estate sector is very risky business to invest in, but it also has an element of cyclicality which usually lasts for a longer period of time. So now currently if you look at the data in the past 2 to 3 years, we've seen that the pre-sales numbers have been growing exponentially for all the major real estate players. Also the number of projects that are being launched in the major cities. You can talk about NCR, Mumbai, Hyderabad, Bangalore, etc. So are we considering investing into real estate players? Is it still considered as a non-investable business, or also we can consider the real estate proxies, which could involve not only the building materials, but your construction companies and other players? Please, share your views on this sector entirely.
It's a sector I've tracked for a long period of time. It's a sector where it's very difficult to build conviction to buy something and hold it. So there's a interesting book that I read by someone who's worked in the real estate space. The book's title is Inside Unreal Estate. I forget the name of the author. Mr. Sayal or something. Maybe Ronak will look it up and tell me. Sushil Kumar Sayal is the name of the author. Now he's worked in the industry and he describes it. So the same real estate sector would have one very successful project, and in some other project will get stuck for some reason or the other, either overbidding or the demand does not pan out. Again, I was watching one documentary about the real estate scenario in the NCR region, where one expressway was to be built and all the projects were supposed to do well, and for some reason that expressway was stalled and people who booked flats and offices over there had a lot of difficulty. There has been a cycle in Navi Mumbai in the past. It was supposed to develop rapidly. It did not. The airport project was supposed to come many decades back. Now again there's a upswing. You have to figure out project accounting, percentage of completion method. People announce full booking. Now, are those bookings by investors or are those bookings from the end consumer? Maybe someday we will. Again, today's favorite phrase has been never say never, so I'll repeat that as well. But at least as of now, I would be surprised if I buy some real estate developer in the next 3 to 6 months. The proxies are great. So we could buy a paint company, a tile company, a faucet company, or building materials or anything like that. Contractors, again, I've tracked for a long time, never had the conviction to invest in.
So one more small part. Do we only look at the fundamentals, or there is some element of technical assessment also involved in your buying and selling of stocks?
There's no technical as such, but Rukun, you have been quiet the entire meeting. Maybe you want to explain your multi-factor screeners and what we do there and incubating of the small internal fund or something like that.
Yeah, so we do track various factors. So things like momentum, how the stocks have been doing on momentum. Then there's a factor on quality. There's a factor on valuation. There's factors on what is the volatility of the business. So momentum is something that some of the technical people might look at, but other than that, there are no technical indicators that we use. Essentially, the idea is to screen for ideas which our research team can then do a deep dive on. And since we are essentially trying to focus on long-term ideas, our models are also built to identify those kind of long-term ideas. So technical indicators, except for momentum, do not play a big part in it. We do run a small dummy portfolio just trying to see how this does over a period of time. So that's a small experiment that we've been running internally. We'll see as it goes.
Thank you so much.
At the front, please.
Hello, Rajeev sir. My question is to you. I have been investing in PPSA from 2019, at the start of 2019, and then come the lovely COVID, and then I redeemed all of my units, by fading out of the event that happened, because I did not had any health insurance, any debt allocation, and things like that. So I fared out and I redeemed, and I think that reduced my compounding effect. Then fortunately I started again at the end of 2020, and then after that for the last 4 years I did not touch my PPFA app. So I would like to hear your thoughts on this, like what one can prepare for events like that, so that their compounding won't get affected.
So not because Neil is here and he is moderating our event, but I think the Mint newspaper runs a brilliant coverage on personal finance factors. So what kind of health insurance you should have, what kind of life insurance you should have, various life scenarios, like what happens if you have a differently abled child. So various, so what are the factors NRIs should consider and all sorts of things. So one is you should definitely read whatever is put out and try and implement whatever is applicable to you. But I think apart from that, one of the best investments anyone can make is hire a financial advisor, pay a fee, someone who's properly qualified, a CFP or someone who comes with good references. Hire a good financial planner, do a proper asset allocation, do a proper financial plan, communicate it to your family members so that everyone is on the same page, everyone is aware, and then stick to the plan and periodically get it revisited whenever life circumstances change. The standard formulas or a cookie cutter approach can only go so far. I think even though initially it may seem like a bit expensive, but I think it helps you over many, many decades. So I would strongly recommend something like that.
Sure. Thank you.
At the back, please.
Hi team, my name is Vaibhav Mishra. Thank you for taking care of my wealth for such a long period of time. I want to ask a question because I have been reading a lot of financial reports these days. Is it true that you are a large cap biased fund? And one more question. In March, when you bought a stock called IGL, everybody said that this is a perfect stock for Parag Parikh to buy good dividends, good cash flow. They exited quite early. I just wanted any thoughts on that. Thank you.
Sure. But if you look at today's portfolio, yes, we are invested more in the large cap space. Will it be the same forever? No. When we look at a stock, we ask one simple question: is this attractive to buy or not attractive to buy? We don't look at whether it's a large cap company or a mid cap company or a small cap company. There will be a time when small caps and mid caps will be more attractive than large caps. At that time, we'll have more exposure in that space. So it's a function of the opportunity set. IGL, it had sold off based on the announcement that Delhi government is going to shift towards electric buses and encourage electric taxis and things like that. There was a big sell-off. We thought that the sell-off is excessive. We bought into it. But over a period of time, the thinking was that while the shift may not happen very rapidly, but in the medium to long term, on a pan-India basis or even globally, EVs will take more and more share as compared to internal combustion engine. So growth prospects were looking limited. We said, so conviction was not that strong when we dug very deep. So we started reducing the position. Price also had run up after that. But after we trimmed some of IGL, then this news of reduction in allocation of administered gas came in, which again was confirmation that it's not such a great stock to continue owning. And we changed our mind very simply. Thanks. At the front, please.
First of all, thank you for managing our wealth and increasing our money sitting on our sofa. A couple of questions that I have is, how does PPFAS identify and analyze investing mistakes? Any example you can share? And the second question is, which other Indian fund house or AMC stands out in your view?
So, I don't know how many people have read this book, Thinking in Bets, Annie Duke, right? By Annie Duke. There she talks about something called resulting, and she talks about playing cards. So her observation is very, very interesting, and it applies to stock investing in a big way, is that a mistake is not some stock where the stock price went down or where stock price did not go up as anticipated. Neither is a stock where the stock price went up rapidly a great investment. These are outcomes. What we tend to look at is the process. Sometimes we may make a terrible investing mistake and simply by fluke or by luck the stock does well, but we don't pride ourselves on having made that investment. Similarly, sometimes we may have done all the work and we have bought something, and for some reason the stock price falls and we make a loss on that investment. That's not necessarily something where we have to learn a lesson for future investments. So that is one. End of the day, investing is a probabilistic endeavor. Out of 10 investments that we make, even if our process is 100% right, there will be 3 or maybe 4 which will not work out exactly as we have expected. So we don't beat ourselves too much on that. We continuously go through the process that we follow, meaning if there was a red flag which we missed, we make sure that that red flag is never missed again in any other investment that we make. If something was knowable and we did not go the extra mile to know that some information that was in the public domain. So, for example, many years back now, it's ancient history, but we had invested in a company called Noida Toll Bridge, and which went against us. Now, was the original investment a mistake? I asked that question, and probably not. But the mistake that I made is that when the court hearings were happening, and those were significant court hearings, I think we should have flown down an analyst to the Allahabad High Court and sit in that hearing to figure out what are the arguments being made, rather than wait for the final order. So attending 2 or 3 of those hearings may have helped, rather than just relying on the quarterly information that was being put out. So it's a very, very fuzzy area. It's very, very difficult to distinguish a mistake from a stock which went down in price. So we try and maintain that distinction, and we continuously try to refine our process so that mistakes reduce over a period of time.
And the second question, which other Indian fund house or AMC stands out in your view?
So there are a lot of people we admire. In some cases these are individuals, in some cases these are organizations. So too many to name, but let's say someone like Mr. Prashant Jain has had a long stint with HDFC Mutual Fund. Now he runs his own organization. He's someone we have observed over the years. We have Mr. S. Naren, who's been around for a very, very long period of time, runs a very disciplined approach. There are certain aspects which certain people are very, very good at. So someone like Mr. Kenneth Andrade, for example, who identifies cyclicals and turnarounds maybe. So different people specialize in different things. There's Professor Sanjay Bakshi, who we interact with and look up to. There are some younger people, Amit Mantri and Savi Jainvi. So plenty of people, maybe we can have a list of 50, 100 people we interact with and we track. So a lot of people.
Thank you.
Thanks. At the back, please.
Hello, sir. My name is Paresh. My question is about Bajaj Finance. Since last year, you have been constantly selling this stock. Is there any thesis around this? And if you don't have conviction, then why not sell or exit all at once?
Bajaj Finance has been an arbitrage position, sir. So we have never owned Bajaj Finance directly. Bajaj Finance, we have only had a long cash and short futures kind of position. In the Bajaj group, we only had Bajaj Auto in our hybrid schemes, and in the equity funds, we have only had Bajaj Holdings. We have never owned Bajaj Finance as such. Thank you. At the front, please.
Yeah. Hi, sir. This is Rahul here. Thank you for managing our funds. So my question is to Neil, sir, on succession, but slightly on a different side. So we know Rajeev sir is not going to leave the PPFAS fund. He's not going to retire. Hope he lives for 100 years. Just a slight context. We had Warren Buffett, who used to ask his CEOs to give a name of two names who should be successors if the current CEO is incapacitated overnight. So just wanted to know on that one.
Yeah, so I think our team's been here since kind of inception. Raj Ronak has been here since inception, and yeah, if something happens, I think the existing team should be pretty good to go by themselves, you know. Again, if we need more people on board, that's the time to think that time. I think also the fact that, let me just go back a little while back, you know, so we do have this example from our organization. So we started the mutual fund in 2013, 2015 our founder passed away in a car accident. Obviously, that time also the question was, okay, what happens? But I think we came together. Obviously, the initial years are always tough. It's not going to be a smooth ride, for sure. 1-2 years is obviously the organization takes to get used to the new normal or whatever you say, you know. So, yeah, within that time, we figured out things that we need to do or we don't need to do. And yeah, and things worked out fine post that, you know. So, yeah, I mean, I think at that time also we ran with the existing team and we didn't need to get anyone from outside, because I think the main thing is the value, the culture, the philosophy that it's ingrained in all of us, you know. So that is the main thing. So if people have that, then yeah, I think they should be fine to go about the business as usual. Thanks.
Thank you.
Hello. Good evening. This is Shiva. I'm from Chennai. For round up, this question is, we have training chips and as well as inference chips in terms of the AI chips market. So, and when NVIDIA, yes, I agree, we missed it, but it's okay. I think as Rajeev said, you were very harsh on your part, but much appreciated. Thank you. But on the inference chips, it is going to rule the world in years to come. So in the inference chips, there are players like Cerebras, Sambonova, and Grok all coming up very, very fast. And it is going to be a Cambrian evolution. So what is the thought process going on in terms of investing in this new frontier space?
First of all, really appreciate you flew down all the way in Chennai to attend this meeting in person. Thank you so much for doing that. See, again, inference chips market today, I think is too early to say. And like you mentioned correctly, there's a lot of companies coming up with different inference solutions which are designed for niche applications. So you might find a market fractured across use cases rather than finding a generic player winning. I think at the architecture level, there are some companies which are interesting, but valuations are very stretched today to even take them seriously. We'll keep tracking this, and as the market evolves, some ideas will become better as cash flows of these companies come up. So we are not in the habit of investing at the venture capital stage where companies are forming their business model or whatever. We'll figure out a company who has understood the business very well, they're executing very well in that, the management team is reliable, and over a period of time the cash flows look reasonable that we can stay invested in this company for a long time and they have a path to grow. So that is not visible yet today in the inference chips market in my view. So yeah, it remains to be seen, but it's an area of tracking that we do anyway. So thanks so much.
Thank you.
Again, inference workloads, while we don't know which chips will win, but I would think workloads will move to the cloud even for inference, and the usual suspects that we own will benefit from that. So the AWS, the Azure and GCP, those will continue to win, I would think, even in the inference workloads. In any case, if I am being candid, the limit on overseas investments is there. So, meaning even if we identify something, is it that great that we sell down Microsoft and Google and we buy that? I mean, given that as it is, we have only 12-13% exposure, we are not doing that deeper work in overseas as we are doing domestically in terms of new ideas. If the limit opens up or down the road in the Gift City fund, those people will probably be more excited about overseas opportunities. Thanks. At the front, please.
Good evening, sir. I have a question from investor behavioral standpoint. So let's say we finalize idea based on due research and we take a position in the company. However, one fine day management becomes naughty and it takes some decision against the minority shareholders. So how do you deal with such situation from fund manager standpoint?
So typically we invest with people who have had a longer track record. We don't invest with very, very new managers. If it's a very serious violation, typically exit is very, very quickly. We don't then look at whether the stock is lower than where we bought it or things like that. If we are at a loss, then we would exit. That is provided we can do nothing about it. If it is in a company where management has a very, very low stake and mutual funds as a group can vote against a resolution or can force the company to retract, then we would make those attempts under our stewardship obligations or things like that. Thanks. At the back.
Sorry, just one thing. We've got a hard stop at 7:15, so we have still a few questions. So if y'all can just keep the questions to one and keep it concise, and we'll try to do the same from our side.
Yes, please.
Good evening, sir. This is Anil. I have been attending this session now to 2 consecutive years. So last year we have a questions on healthcare sectors, right? So you have been saying straight away no for a healthcare sector, but companies are like, is this stock listed in healthcare sector, specifically hospitals, wherein they are looking for OPD, real quick, like surgery and dispatching the patient in a day or two. Are you looking for these kind of stocks wherein, is there an opportunity for you to invest?
Simple answer is yes. We are tracking that space and maybe you will find something in the portfolio if we decide.
Something like Vedanta and all.
Thanks.
Thank you, sir.
Yes, please.
Good evening, sir. Thank you for giving me this opportunity. Sir, your views on A, turnaround companies, B, new age companies like Zomato, PB Fintech. Will our philosophy or thought process, which we discussed earlier, make us stay away from them? Thank you.
We track newly listed companies all the time, so in India and abroad. So some of these spaces have been very, very interesting. So we have been tracking the ride-hailing space. So Uber and Lyft kind of companies, for example, globally. We track the food delivery companies and quick commerce companies in India as well. So we are not venture capitalists. So what we require is a good track record of profitability and we require reasonable valuations. As and when those things start coming and we clearly identify the winners, we may invest. So we do track them, but as of now, there are no investments there.
Sorry, if I can, not a more question, but you missed the turnaround companies.
Turnaround, typically, we are not big turnaround investors. Typically, we buy companies where there's consistency of profits, etc. Cyclicals, yes. So if it's a very, very well-run company going through a cyclical downturn and stock price has sold off, we buy in a meaningful way. Thank you. At the back, please.
Hello, sir. My name is Priyanshu and I am from Jodhpur, Rajasthan.
Thank you.
I would like to ask a very simple question that how can a college going boy like me can sit at your place and be a successful fund manager? And disclaimer, Neil sir, this is not a succession question.
So there are multiple ways to it. So one way of managing equity investment portfolio is simply open a demat and a bank account. You can be in business on Monday. And like we have had people like Mr. Rakesh Jhunjhunwala who did precisely that. He never was employed elsewhere, did not take a salaried job and became an investor. We had someone like Mr. Chandrakant Sampath who was an individual investor. He was not a stockbroker nor a portfolio manager or a fund manager and did it himself. Typical path, complete your education, either do a MBA finance or a CFA or a chartered accountancy and seek employment in the larger organization and go up the rank. That is one. Or join a smaller organization and you move up the ranks quicker, but the size of the assets, the size of the pay packet is limited. So yeah, it's like saying, how do I become a film actor? Join a film training institute and seek work with directors, as simple as that.
Sir, secondly, how can I join your turtle gang?
By being here each year, you are already part of the gang. Thank you.
Thank you.
At the front. Tortoise, yeah, it's tortoise, not a turtle. Turtle is a sea animal. Tortoise goes on the land. Our logo is the tortoise. Yeah, yes, please.
Good evening, everyone. Thanks for holding this session. My question is on holding companies. So, when we invest in holding companies, what is the discount that we consider that the merit is in investing in the holding company? And with the new regulation enabling thing, do you think that the holding companies discounts can go back to the earlier 60-70% levels? And the third linked part is, when we invest in the holding company, do we also look for the valuations at which the underlying companies are trading at?
Yeah, starting point is underlying companies. Do we like them or not? And what valuations the underlying companies are trading at? Discounts, typically we would want more than 50%, but there's no hard and fast rule. The bigger the discount, the better. I don't think the regulations change the discount rate in a very significant manner. Thanks.
Not a question, just a suggestion, sir. If you can consider writing a book on your history.
Too early for that.
Maybe
when I retire, maybe.
Earlier
Thanks.
guy will have his question answered.
Thanks. Next, please.
Hi team. Hi Rajeev, Raja and Ronak. And Neil, I follow all your posts on LinkedIn. I have a stock specific question about HDFC Bank. Earlier that question came up. Why is HDFC Bank specifically underperforming as compared to ICICI or Axis? And what are the levers? That part you missed answering in the earlier question.
So each company goes through its own cycle. There will be periods where one bank is doing well, other is not doing well. HDFC specifically has undergone the merger with its mortgage lending parent. And there has been this management transition plus this big merger. I think operationally they are doing what they are supposed to do. I don't see that as so much of a challenge. Actually, more than HDFC Bank, it's been the cleanup that ICICI Bank went through post all the issues. That's why the contrast looks very, very stark. Otherwise, not much to comment on as such. HDFC Bank is doing what it's supposed to be doing. Thanks. At the front.
This is regarding ITC. First part, there was a buzz about 35% GST and the cigarettes moving into that slab. And a related question regarding ITC is, what portfolio action are we expecting for the hotels business from your side?
So, GST taxation is a fact of life for all these sin companies, alcohol, tobacco and all. Ultimately, they are able to pass on. So, I don't see much reason to do anything. Hotels business, after the demerger, we'll watch what the valuations are, what the prospects are. So, I don't think there's any predefined action that we have in mind. Even if we had, I cannot announce in a unit holders meet in advance what I'm going to do. Typically, you will find portfolio actions in the monthly fact sheets and portfolio disclosures. So, I'll do something first and then communicate why I did something. Rather than, otherwise I'll probably be in jail. I'll be debarred from the security markets for encouraging front running. So, yeah.
But we are okay with owning a hotel business, if you put the question the other way.
We'll see. We'll see. At the back, please.
Thank you so much, sir, for this opportunity. It's my first AGM. I have a different question. Both Indian and US markets have provided great returns since last decade. But China is a cheaper or struggling market as compared to this. Since through Gift City, I have seen Neil's video, we can invest through global exchange. Should we buy Chinese stocks like Alibaba or China banks? I'm scared of Chinese government.
I have a 1-hour talk on China as a market. People who are keen can watch it on our YouTube channel. Short answer, we are not considering investing in China. Very, very short answer. To the person who asked the question earlier on new age companies, Zomato and all that, I have an older talk. This is 2021, I think, valuing loss-making companies, again on our YouTube channel. And there's a recent talk that I've given, again on some of these startup kind of companies which will be put up shortly. So you could refer to those things. But we are not looking at investing in China.
Thank you so much.
At the front.
Yes. So because you guys are all professionals who have assimilated so much information over so many years about corporations, I'm more interested in your world views of the long-term futures on how these antitrust movements have happened in America and how they might change our, in a sense, lives. I mean, in a non-fiduciary sense.
Same applies for India, same applies for these globally large companies. Is Amazon a net good for society? At one end, so many new companies who earlier did not have a distribution are able to set up their own small businesses and sell on things like Amazon. At the same time, it's hurting the neighborhood corner store or the small retailers. The consumers love these 10-minute grocery deliveries, huge amount of convenience, and again, if you need something late at night, maybe a Band-Aid or something, or aspirin, maybe you can get it, or you run out of milk and you can get it at midnight or even post that. Great service for customers, but is it hurting Kiranas? Sure, it's hurting a lot of Kirana owners. I don't have much insight, and again, it's late in the day. All of us are headed home. Maybe we'll think about this, but I don't have clear answers in terms of what antitrust should do and what will be the societal impacts. Thanks.
Good evening, sir.
Yeah.
And my question is regarding Zydus Life, which is almost 1% of our portfolio. When going through the balance sheet of Zydus Life, I found out it was having around 5,500 CR of goodwill. So, though major part is coming from its wellness business, isn't it a red flag for the size of balance sheet of which Zydus Life commands? 5,500 crore of goodwill, isn't it a red flag?
So, as you mentioned, it's because of the Zydus Wellness, the FMCG business that they have as a subsidiary, and they did this huge acquisition, Heinz, right? The Kraft Heinz portfolio. So, I think the goodwill is a result of the premium. So, no FMCG brand you'll ever be able to acquire at the book value, because book value will be negligible. When you acquire a big brand portfolio, it will always result in a huge amount of goodwill. Again, this was a completely unrelated transaction. So, Kraft Heinz is a global multinational, and the Zydus Group is a Gujarat-based, completely Indian promoter, and the transaction was also, various bids were invited, and these people won that acquisition in a transparent manner. So, I don't see any reason for there being a red flag. Again, the auditors and the accountants and the management have to periodically look at the goodwill to see if there's any impairment under the new accounting standards. As long as there is no impairment, then the goodwill will stand. So I don't see that as a red flag. Thank you. At the front.
So my question is regarding Asian Paints. It's facing pressure in the markets. The prices are at the lowest and the PE is at the lowest, and it already has a history of healthy balance sheet. So you're facing pressure on the selling end. Do you see an opportunity here where you're getting a healthy company, good history at the lowest price, and companies with good balance sheet have historically survived the competition? So is there a thesis on your end?
So in general, typically we will not communicate in advance if we are wanting to buy something for obvious reasons. But in the opening remarks, I mentioned that whether it be paints, whether it be stock brokerage, wealth management, consumption space, everything has been bid up, and people are not factoring in the competition risk enough. Despite the fall in stock price, do you see Asian Paints being at a throwaway valuation based on its own past history? If you go back long enough, I think when I started professionally managing equity investments, Asian Paints was among my early investments. This is way back in 2003. That time it was barely about 15 times earnings. So it's not that it's always traded expensive. It's just that in recent years it got bid up, and we will see how competition pans out. So obviously when some stock sells out, we keep track of it. We will see as and when things pan out. Thanks.
Thank you.
At the back.
Hello, my name is Charvak Naik and I am an individual investor. First of all, thank you so much for giving such wonderful knowledge to people like us. Now my question is, when evaluating a potential investment, how does PPFAS as an organization think about the discount rate? So do you use a rate like Buffet, for example, a 10-year or 30-year government bond rate or anything else? And once you have determined a particular discount rate for an investment, how do you make sure that it is conservative? And as an individual investors, how can people like us protect ourselves from making the mistake of being overconfident on discount rates?
So you mentioned Buffett and his use of discount rate. There was a conversation between Charlie Munger and Buffett, and someone who was asking question to Buffett about discount rates. So the question to Buffett was, how do you value a company and what kind of discount rate to use and things like that. So Buffett was explaining the value of any stock is all the cash flow from now to eternity discounted to the present value and things like that. So Munger said, you talk about discount rates and all that, but I've never actually seen you do one. And then Buffett said, there are some things that you do only in private. Alice Schroeder, who's the biographer of Warren Buffett in the book Snowball, has described his investment process. I don't think, so Buffett clearly does not use Microsoft Excel. His use of the computer is for playing bridge games, not for doing complex DCF analysis. It has to be very, very obvious. Even at our end, we don't do complex multi-year or multi-decadal forecasts, and we don't put discount rates.
Thank you so much.
Thanks.
Even I am on the same page. Even I don't use Excel.
Thanks.
Just felt nice that you are also on the same page.
More exciting fiction is written in Microsoft Excel rather than Microsoft Word. Yes, please.
Yes, sir. Good evening. Sir, thank you for the wonderful work you all are doing. I had a query on the power grid InvIT. It's quoting at about 13-14% below its issue price. Do you all have a view on that?
Yeah, so part of the yield that you see is your own principal coming back to you. So a lot of these InvIT assets don't have a redemption value in that sense. So it would be difficult, or it would be incorrect to compare that with a bank fixed deposit or a yield. So we track it, but yeah, we don't own it currently. Thanks.
Thank you.
Thanks. At the back, please.
Hello. Thanks for conducting the AGM. Just wanted to know about what's your thoughts on quant fund, and also do you incorporate such data points in our research process?
Yeah, so Rukun tracks multi-factor, runs multi-factor screens, which is typically referred to as a quant approach to investing, but it's essentially to help the research team. We don't have a quant-based fund as of now, and nothing on the horizon immediately. Thanks. Yes, please.
Neil sir, wanted to know what controls and checks we have in place to safeguard unit holders' interest, especially when the dealing is happening between buying and selling of shares.
So again, because of some certain issues that have gone in the past few years, this has become very strict, and we have a very comprehensive circular from SEBI about what we need to do in terms of front running and all those things. So obviously the obvious things are access control, not having phones, again everything is recorded, You cannot use your mobile phone there. You cannot do trading. So none of us can buy and sell. We can sell existing shares, but buying and selling of individual security is not there. So, and that's for us and our spouses and children and all that. So I think that's taken care of. Also the fact that now we have to, again, when they're giving the buying orders and stuff like that, we make sure that we are not a large part of the volume that day, and there are certain things that they define, and that's for them to know. Also the fact that if now we have to give actually data to MP SEBI about if certain breaches have happened in terms of when you're buying or selling or doing a transaction, which generate level 1, 2, 3 kind of a thing, which are still working on it. The industry is still working on how to make this more efficient. So again, a lot of things are in place to safeguard that there's no front running or anything adverse happening. Obviously, a lot of training is required. We talk again what can we internally do better, and we do those things.
Thank you.
We'll take the last question. Thank you.
Good evening, sir and team. My name is Janendra Prakash, and I have come from Pune. So my question is related to the AI and Indian IT industry. So most of our huge IT industry is made due to the outsourced work from the US, even though we have some domestic work now going on. But with the AI, we don't have any Indian company who is making their own LLM models, and all the works which we were getting now can be done by AI instead of having huge teams in Indian IT back offices. So do you see shrinkage of our Indian IT industry, and as well as huge shrinkage of the small IT companies who were just doing the IT coolie work for US?
So there's one trend which is in the market, which is happening for a long period of time. Basically, companies are setting up their own back office operations in India. They are called GCCs, Global Capability Centers. And these are companies who are also customers of our IT companies, which are exporting IT services to them globally. Now, that wouldn't happen if there was a lack of talent, number one, and number two, everything can be automated. So companies are clearly seeing the value of the Indian IT services business model and the availability of talent over here to do all sorts of back office work which was done by IT services also. Now, IT services is a small part of the job or tasks which can be automated to a large extent today because of AI tools available. But imagine getting a contract to install or implement a core banking solution. Do you think an AI system can take end-to-end responsibility of implementing that core banking solution for a bank? Would a customer also want an AI tool to do the job rather than seeing that different implementations happen at different stages at the branches? People are knowing how to use that in terms of using the right protocols, risk metrics, everything in the software. All these things you need a large amount of manpower to design all these packages inside the app, at the same time implementing them at the end level. So the nature of the work that IT companies do has always been changing. As the DNA of this industry, the past 35, 40 years they have been around, they have gone through several changes, right from using mainframe servers to using thin computers to using cloud computing and now towards AI. So they have to change the tasks that they sell to the end customer, change the product and offering that they have to the end customer. That is their challenge to figure out. But I don't think AI is a service or a tool which can solve everything and can take care of all the human tasks and nobody will work in the IT industry. So shrinkage I don't think will happen from the services part. Services will keep on needing more services in the future. How they are sold is, again, that's the competitive nature of the IT industry.
Thank you everyone for coming and spending time with us and being so patient. We really appreciate your time here. So thank you everyone.